which is always fun. But we're here to talk about Web3. Obviously, interesting times we live in. Things have changed a lot in the last few months. And to be fair, when we thought about our event calendar, we looked at the schedule, and we had some conversation about, should we do this event? Should we stick with our plan to bring people together for New York? And to be very honest, we weren't quite sure how much appetite there'd be in the community for something like this. But I think that any doubts we might have had, we've definitely dispelled them today. So thank you very much for showing up, and I think you guys are going to find it was a good decision. Just a few partners that we'd like to thank before we get things going today. If you guys have walked out and you've been in the pit stop area, you'll notice there's a lot of fun stuff to do, and there's a few people that we just need to thank. I want to start with Bye Bye Plastic. And I'm going to come back and talk about sustainability in a minute, but they've been very helpful in helping us make this a zero waste event, or at least as close to zero waste as is possible with something like this. Our friends at AWS, thank you very much for your support and for sponsoring us and this event. They're an important partner for us, and we're excited to be working with them. QuickNode, Mirror, our production partner. So a lot of the beautiful things that you see, and I think what makes events like this great is the little touches, so pay attention. There's a lot of small things, whether it's the grass on the ground or the fact that that was a parking lot yesterday, or the original art, the murals, the art behind the simulators. It's all original art that was done just for this event, so very excited about that. Avalanche has been with Avalanche from the beginning, and we're really happy to get their support, so welcome to Mark and team. And then finally, Lunar Crush. So appreciate you guys showing up and supporting our event. Just a little bit about the zero waste stuff. We care a lot about sustainability. I don't know if you guys know this. We don't make a lot of noise about it. We probably should. But when it comes to the amount of energy required to secure or create a dollar in value on the blockchain, actually nobody comes close to Avalanche. And that's because of our consensus protocol, because it's quiescent and super energy efficient. The whole Avalanche blockchain uses the same energy as 46 US households every year. So it's very, very low compared to like 1.6 million for Ethereum. And Bitcoin is something in the order of 8.6 million households worth of energy every year. So we're very, very proud of that, and we try to bring that sustainability focus through everything that we do. So if you look around you, this is, like I said, as close to zero waste as possible. The DJ booth is decorated in used t-shirts, if you want to notice that when you go out there. We've used a lot of reclaimed material. You'll notice the painted tires, taking trash and repurposing it, turning it into something special. What else are we doing? We've got, the speaker and press badges. This is kind of a fun touch. I just found out this morning. They're seeds. So if you decide to drop it off when you're walking home, just drop it in some dirt. And I'm not sure exactly what will grow, but something live. Yeah, not sure what strain it is, but we'll have to figure that out. It's all compostable, most of what you see. So thanks for your support in that regard as well. All right, that's enough of the administrivia. You guys know where the bathrooms are, you know where the food is, and the fun is everywhere. So without further ado, we're going to launch into our first panel. And I want to bring up one of the guys that, if you're in the community, you probably know Joe Ferrara. He almost has an awesome last name, just a little close. But Joe's been with Avalanche, one of the first guys actually on the team. And he's going to be leading a really interesting panel here to talk about how we bring more Web2 gamers onto the blockchain and Web3. So without further ado, please welcome Joe Ferrara.
Hey everyone, yeah, really excited today. One of the big topics of conversation that we want to talk about right now is Web3 games going mainstream. This is going to be a big deal over the next, I would say, year or so. We had a really interesting, beginning of crypto games with DeFi games. Then you had casual games, and now you're actually going to start seeing games going more mainstream. So I want to bring on some of the few folks on stage. Todd, do you want to come up? And Anton, Pasquale. Awesome. So I think, just to kick things off, it would be really good to, before I dive into all the questions that I want to start talking about with crypto games and where things are going, I want to really understand just the backgrounds of each of you and the project they're working on. So why don't I just why don't we start with you, Anton? Just talk about, what Pocket Worlds is at a high level and what you do there.
Yeah, sure. Well, great to be here. Thanks for having us. So our company's called Pocket Worlds. We have two products, one called Highrise and another called Everskies. And they're both UGC virtual worlds. I guess people today call them metaverses. When we started in 2013, they were called virtual worlds. And we have about 2 million monthly active users on Highrise, about 1 million monthly active users on Everskies. Both of them are actually mobile first, although Everskies has a web presence and Highrise is coming to web in about a month or two. We're about 100 people, did about 30 million in revenue last year, about 100 million in secondary market transaction volume. And we are building a subnet on Avalanche today to power our economy, which we'll talk about later.
Awesome. Pasquale?
Of course, thanks for having me here. My name is Pasquale, I work for Bloodloop. Bloodloop is probably the world's first MMO FPS built on Web3. If I had to oversimplify it, I'd say that Bloodloop will be, if you're gamers, a mixture of Destiny and Fortnite. And we're trying to push the adoption barriers of Web3, providing users with something they're already fond of on Web2 gaming. Building it, though, with a very strong player-driven economic model that can last long and can go autopilot once the game is launched. Of course, we're building on an Avalanche subnet, even though we are hard forking the subnet to build in our own function thanks to the incredible personalizable feature of the subnets. And I'd say that's it, yeah.
Awesome. Yeah, really excited about first-person shooters, especially. Todd, why don't we kick it off to you?
Yeah, nice to see you all, and thanks for having me. So I'm the co-founder and COO of GameStar Plus. We are a nascent streaming game platform. We kind of refer to ourselves internally as the Netflix of game night. So think about a multi-platform streamer, anything from connected TV apps, game consoles, mobile phones, even just the web at GameStarPlus.com. And just clusters of like hyper-casual, familiar, like durable brands that have powered game night forever. Everything from adaptations of card and board games to every AAA game show you could imagine, streaming Family Feud with Steve Harvey hosting a game night in your living room. Monopoly, Clue, Risk, those sorts of things will be coming as well. Wheel of Fortune, Jeopardy. And the entire platform has a virtual currency that's built on Avalanche. So, we're really excited about kind of breaking the wall that has always existed in these virtual currencies. Obviously, it's a one-way valve. Like, you can put money in, but then it's kind of locked in that game. There's a really cool opportunity here to actually, put money into the game, turn it into more, and extract real-world value for the users. So, we're super excited about that.
Yeah, definitely really excited, and actually I want to unpack a little bit more there in a little bit. So I guess before we dive into just a little bit deeper on specifics about your games, I want to understand a little bit what made you want to go into Web3 game and convert actually from Web2 to Web3, and what are some of the key benefits that you think bring with Web3? Why don't we start with you, Anton?
Yeah, sure. So we have a virtual economy. We have a lot of secondary market transaction volume, people buying, selling, trading, currency, virtual goods between each other on our centralized database. I guess, so I got into blockchain in 2013. That's when I first bought Bitcoin. In 2018, we actually did an Ethereum-focused NFT project. This was like very early in NFTs, and realized the infrastructure wasn't there yet. But the reason why we've been kind of experimenting and exploring in this space for so long is because we have this fundamental belief that the right technology for a virtual economy, or an economy that is like entirely virtual, the right technology for that, foundationally, is composable permissionless money, right? Because once you have composable permissionless money, anyone can build or integrate applications that use your money, or use your NFTs in the case of non-fungible assets or tokens. And so that's why we've basically since the advent of blockchain thought this is the right tech for the kind of products that we build and the kind of worlds that we build. And actually when kind of Avalanche came along is when we saw an opportunity to build something that has UX that can work with our users, right? We're not a business that's trying to attract necessarily a ton of crypto native people. We're actually trying to bring our 3 million MAU over to use this technology so that they can access exchanges, so that they can rent out their assets, so they can do kind of everything that again, composable, permissionless infrastructure allows and enables without necessarily needing to like launch on Steam or something like that, which is a centralized, very much controlled, kind of API-driven ecosystem. So yeah, that's why we're moving in that direction.
So it sounds like composability is like a really big thing. And would you say like liquidity or extracting value is like, I guess, like another piece to that? And that's, I mean, I feel like that is one of the big pushes of why people are going Web 2 to Web 3. Is that what you're seeing with, like, how are you thinking with like first-person shooters, and you know, what made you want to kind of go and make that jump to Web 3?
Well, in general, of course, I agree with Anton with the most part of what he said, actually, with all what he said. But the main reason for Bloodloop to be built on Web3 rather than on Web 2 was the fact that we have seen that Web 3 can be considered as the natural evolution of gaming. As a gamer, I probably spent thousands of dollars on worthless skin that I can't resell, and that I'm going against terms of service that I try to resell on secondary marketplace or whatever. And all the money that I've spent are literally locked in the game that I've played. And the majority of the Web 2 games are exploiting users as a cash grab, basically. So you get, of course, you give them something in returns for the money that you've spent, but you're just actually renting out server space, and you're getting something as long as the game lasts, and you're never actually own the asset that you bought for. And of course, that's where the natural evolution of gaming kicks in. The fact that the users are spending for something that they actually physically, or at least they are certified that they are owning the asset that they paid for. And at the same time, Web3 allows for founders to actually give back to what makes a game successful, which is community. Your game could be the best one on the market, but if you can't attract user, and if you're not rewarding your user for the time that they spend on it, it's not going to work. So I think that projects and founders and games should be giving out the most that they can back to their user for what they're doing. Because of course, they are the one, especially in player-driven economic model game, even World of Warcraft, an example, they are the one running the game. Without them, the game won't work. So they should be rewarded for that.
Absolutely, yeah. And I'm waiting for the day where I can actually sell my mounts. I've played a ton of World of Warcraft, and I just need to offload that. So, but I guess with Todd, you know, I'm actually curious. You know, you're disrupting a really interesting industry with. You know, you're trying to take over board games, and with interactive gameplay and blockchain. How does Web3 tie in with your strategy to attract users, and where does that come into play with you?
Yeah, it's a good question, and I think Anton actually hit it. Like, we're not really looking, you know, specifically and narrowly for the Web3 crypto blockchain savvy players. Of course, they and all are welcome, but this is like an extraordinarily mainstream, like Main Street product. So, you know, first and foremost, it is important that all these experiences we develop deserve to exist on their own. Like, they're just straight up games that, you know, are fun session after session, they're engaging, they're rewarding. We're not necessarily bending these games around the fact that there's a token or, you know, a play to earn component, because I think we've seen a lot of recent examples of games that exist only for that going down and potentially likely not coming back. So in actuality, like, our blockchain layer will be largely opaque to the average user. You know, you think about the large swath of the population that gets pulled into game nights relative to maybe like what the, you know, to your point, what's the hardcore like Steam gaming population or console, those, you know, those are different audiences. So to the user, this will occur just like any other virtual currency that they've been familiar with since Mario Brothers. You know, some coin or point system that accrues based on performance or continued engagement or, you know, outcomes, and obviously there's levels and gamification and all that other stuff. You know, the component that's available for those that want it and are keen to dig in is essentially that two-way valve again, right? Where the in-game currency can be converted into our governance token, taken off platform, and then bought, sold, traded for value, and all sorts of really clever and thoughtful utility for the token within the game to actually enrich it, embellish it. You know, things like entering tournaments, time-based, you know, multiplayer tournaments, skins, all the things you'd expect, you know, typically. And so this is the first time that there is a game platform, you know, that has all of these different, very unique games within it, but a singular virtual currency as the connective thread between all of them.
Yeah, and it's interesting. I think there's been a lot of different implementations with crypto assets and games, and figuring out the economics, right? How do you? So I mean, even Web2 games had this issue with creating sustainable economics. This is World of Warcraft had a ton of inflation with gold, and so figuring out how you create sustainable economics with crypto assets is another issue, right? Because you have access to liquidity, composability with applications. So what are some things that, and I'm going to leave this a little open-ended, so anyone can take this, but what are some things that you purposely maybe have done to have sustainable economics, and things that you're thinking about when it's involving other financial products involved with your game or owning these assets? And so, yeah, I'll leave that one kind of open-ended.
Yeah, if you don't mind, I just want to kick in real quick. I was talking about with Anton before the panel, and I think that applies most to the type of game that we're building. Honestly, the first thing that you have to do when you're thinking about a game right now on Web3 is to run as fast as you can from the dual token, reward token model, and game token system. Because if the game is actually paying out for rewards from its own token liquidity, at some point it's going to collapse, because it's a game that needs to run on user acquisition. And in an example, during this bear market, you wouldn't be able to acquire users. So the best thing I'd say, and that's what we're doing as well, is trying to actually run on a governance, even if you want to run on a dual token system, run on a governance and game token system, where you're not directly rewarding users with cash, but you're rewarding them with incentives that they can use in the in-game economy to actually gather some rewards from other players. As long as the economic model is run from players and they're setting the prices, they're setting the price bars, then it's going to probably work out. And it can also work with just 10,000 or 15,000 players. But when you're requiring player to pull in liquidity, then it's going to collapse at some point, because there's no point, there's no sustainability in this one, this model.
Absolutely, yeah. Oh, do you have something going on?
Yeah, I mean, I'll just share that I think our goal is to give value to our users, and they pay for it in some way. They could pay for it with US dollars. They could pay for it in our token. They could pay for it in USDC. That's our job as game developers, is to create that value. What the permissionless composable infrastructure does is it allows others to basically tap into that value and create infrastructure around that value, so that that value can then be, it could be levered, it could be exchanged for other assets. There's lots of things that are made possible when you have a permissionless composable ecosystem. But our goal is to create value where our users can actually obtain virtual goods that they want. In our case, when it comes to both High-Rise and Everskies, we're status games. Right? The end game, I think for any multiplayer game, whether it's a competitive skill-based game or it's a cosmetic game, the end game is status. How do people see you? What does your social network look like on that platform? And that's ultimately what people pay for. That's why I paid for these shoes. It's like I'm trying to gain status. And ultimately, that's kind of what we sell within our ecosystem. And then what we're trying to do is allow all these third-party developers and applications using this permissionless composable ecosystem to basically create applications or features that can tap into that kind of status game and the value that we sell, if that makes sense.
Right, and I think the biggest thing for crypto is just like the user experience, right? That is the toughest thing. That is one of our biggest missions that when we're working on the core wallet and trying to streamline user onboarding. And that is such a major piece of what we're trying to do on Avalanche. And so I think with games, how are you guys thinking with onboarding users? And Todd, I know you're going into a really interesting industry where you're with board, taking over the board game industry with interactive gameplay. And so what does that exactly mean when you onboard a user with something that historically has just been really easy to pick up and start playing, but now you're introducing this whole Web3 layer. How are you thinking about onboarding users into your world?
Yeah, that's a good question. For us, frictionlessness and elegance and ease are the orders of the day. If our user experience can't check those boxes, then we are failing, because this is a platform made for everybody. And our expectation and hope is that GameStar will reach that level of sort of adoption ubiquity that pushes through like generational barriers. Like for instance, you know, my dad, 72 years old, lives in the Midwest. Like the two things that he can do that he feels proud about is he can check his Facebook. I wish he wouldn't. And he can stream. Like he can do Netflix. So he loves that and he loves telling me about it. Like we need to be at that level of like approachability with respects to the first time user experience, the onboarding, the tutorials, and again, letting people self-select into like greater levels of like depth or intrigue based on their appetite. Because again, we kind of have the challenge of serving like an extraordinarily like broad market from, you know, non-tech savvy, you know, folks all the way to very hardcore gamers. Like something I didn't quite fully understand until we started developing this business a few years ago is there is actually a huge overlap between hardcore gamers. I mean, I'm talking like 100 Thieves, like, you know, FaZe Clan type, who are like really keen on this. This is what hardcore gamers do to unwind. They play board games. They play casual social games because hardcore gaming is work. So, you know, creating an experience that allows people to self-select into those different levels, I think is the most important, that we're not hammering people over the head. And, you know, it creates challenges for us too, like with respects to our messaging, you know, what we're saying to what audiences and what channels, right? You know, at the end of the day, I think that it's better to be early on this stuff. And again, just being, you know, really thoughtful with the deployment. And, you know, I would just briefly address the question you asked before, because I think it's a really important one. You know, how do you create economic stability within these games so you don't instantly like become Venezuela or something and you're like, oh gosh, that didn't go great. I got to give a big shout out to our crypto incubation partner, the Faculty Group. The core GameStar team are product guys, entertainment guys, like I'm ex-Sony, you know, people that have rich histories in like gaming and product and streaming. We are not crypto, Web3 subject matter experts, but they have done everything, you know, from the incubation to the token utility to an extraordinarily thoughtful dual token model that essentially takes out the destabilization of like, you know, being tied to something else. It's a pretty simple model. The more people use and like and enjoy our platform, the you know, the crypto or the value of that, you know, creates upward pressure there. So that was something they did a, you know, fantastic job with. I think is super important.
Awesome, and then I guess going to you, Anton, on the you know, user experience front, we've been talking with you guys for a while about deploying you know, a subnet and how that works for the user experience. What are some things that maybe you guys were thinking about with onboarding users? I mean, you already have this existing user base. How are you thinking about how that's going to affect your existing user base with that conversion, especially with onboarding? How are you thinking about the whole user journey there?
Yeah, I'll share a few things. One, in terms of the kind of going back, this is related to the sustainable economy thing, is we're never doing a private sale or a public sale of our token. We are only distributing it to our users as rewards and airdrops for participation in our ecosystem. I think that's one way that it doesn't necessarily need to lead to like a stable economy, but I think it's an important component. Because it means that you're not selling 20, 30, 40% of your token to a bunch of financial speculators with a 2-year time horizon. And so it's really important for us that we're able to do that. We have the luxury to be able to do that as a profitable gaming company. In terms of the subnet, so our core focus is very much user experience because we're trying to onboard our existing users into this ecosystem. And so the way that we're doing that is kind of in order of operations. We're giving people wallets that are custodied. We're working with some third-party vendors to do that. Then we're solving the bridging problem, which is, hey, you have your assets now. Maybe we airdropped it to you. How do you get it out of high-rise, or how do you use it or leverage it? Do you use an exchange on our subnet, or do you use an exchange on the C chain? Likely, we'll start with bridging so that you can bridge your assets over to the C chain. And then use an exchange on the C chain. And I will say that I think for us, the way that we think about the UX, we care more about how you get rewarded and how you use your currency than how you get that currency out and how you swap it for, say, USDC or whatever. If you're going through that effort, you're going to go through the effort to learn. I think the real challenge is on the onboarding, right? Like, how do you actually first get the token? How do you actually first have the ability to spend it? And that's like our first order thing that we're trying to solve. And the reason why we're using the subnet is we can use our token as the gas token. We can cover the fees on all the transaction fees. We can work with our own on-ramp partners, so we're working with fiat on-ramp partners for people to be able to buy the token, all that kind of stuff. So for us, it's like the onboarding, and then if you want to exit or you want liquidity, then you're kind of a more experienced player. You're going to go through the effort of kind of figuring that out. But although eventually, long term, we want to make that also super seamless.
Awesome, yeah. And I was actually also going to ask, what kind of drew you to Avalanche, and what made you want to actually deploy on it? User experience sounds like part of it. Pasquale, why don't we kick it off to you?
Well, the choice was obvious regarding Avalanche, mainly for the subnets opportunity that you guys gave us. So in general, when you're trying to build up a game, you either go for your own layer 2, which is going to become most likely a ghost chain because your only project running on that layer 2, or you are using an Avalanche subnet. And it was the best obvious choice that we could make, also because of how customizable it is. As I was saying, we hard forked the subnet code, and we actually developed a gas fee selective subnet that allows us to give out to users the ability to not pay for gas fees when you're doing transaction in-game, and you're only paying for gas fees when you're interacting with the DeFi backbone related to the game or the bridges and the swaps. This basically removes one of the biggest friction points for Web2 users, which is continuing to pay, even if it's a very small amount, after you have already paid for an NFT to play the game. I mean, if I'm playing League of Legends, in example, I've downloaded it, maybe I've bought a skin, but I don't have to play each time I want to do, I don't have to pay each time I want to do something. And that's a very big friction point in the ecosystem. And of course, then the Avalanche subnets gave us the speed that we needed for transactions, because you don't want player waiting even for 3 seconds for something to go through. It can happen 1 time, it can happen 2 times, but at the 3rd time, you'll get impatient and quit the game. And that's something that always happens. I mean, gamers has the attention span of a goldfish, so you want to keep them focused as long as possible on the game without them having to quit or to do anything else. Apart from that, the Avalanche ecosystem is brilliant, and it's very vibrant. It feels like being part of a family. You guys are super helpful. If there's anything wrong, we can just get back to you real quick, and you don't get this experience with any other chains and with any other provider on the market.
Awesome. Yeah, and I think on the subnet piece, the gas token structure is like a big piece of why a lot of games are interested in looking at how they actually can integrate it. And the user experience, when you change the gas fee token to make, using your game token as gas is kind of a really interesting thing that's been going on. Todd, what kind of drew you to Avalanche?
Yeah, I mean, for me, it's a combination of a few like kind of macro things. Like the first of all is like the size, the scale, right? I mean, a major player. Also the focus, right? A big emphasis and a keen interest in gaming. And the third thing was the aligned incentives, right? Like I love how proactive Avalanche and Blizzard are with investing in and like really getting skin in the game for their companies. Like that is like one of the biggest fundamental principles of our business is aligned incentives. Whether it's one of my co-founders who's Steve Harvey. Like initially we were just going to pay him to appear in games, and we ended up striking a deal. And he's one of a few people on the founders cap table. Like he has incentive throughout the life cycle of this business to serve as the face of Family Game Night, to host Family Feud and other titles, to do press tours, to include this and stuff. So whether it's stuff like that, or the faculty group, who obviously has a lot of skin in the game on the token side as well as the equity side, or here with Avalanche on the blockchain, I think you kind of put yourself in a bad spot if there are component parts of your business that are mission critical and the folks that you're relying on to fulfill them don't have the same upside you do. So it's kind of a combination of those things. And I actually do personally really have a keen interest in the sustainability thing, because obviously that's kind of like a big dark thing that not a lot of people talk about in this industry. So I like that y'all are out in front of that, and these things are like edible or whatever. So yeah, it's awesome.
Awesome. And I know that we have less than a minute right now, but I want to end off with just some key updates that you can share over the next 6 months that you're looking forward to, and what people can expect. Why don't we kick it off with you, Anton?
Sure, yeah. So we're launching something called the High-Rise World, which allows anyone to build their own high-rise. So basically, you can take our platform and take our tech, and the way that we think about it is if you're a brand or a community or an IP holder, you have a Reddit, you have a Discord, we think you should also have a high-rise. That high-rise is essentially your own Roblox instance or sandbox instance using our technology. It's not going to be for everybody, but it comes with a business model. You can sell virtual goods into your high-rise. Obviously, it's a place where people can connect and socialize. Your fandom can create content in your high-rise. And so we're launching our first third-party high-rise next month with an NFT collection called Capsule House. And we'll be working with a bunch of other NFT collections to launch their high-rises, as well as some other communities that are outside of the crypto space. So that's a big thing. And then obviously we're launching the subnet and our token and all that kind of stuff within the next 2-3 months.
Awesome. And real quick, Pasquale.
First of all, I have an update that is actually live, will be live right after the panel, which is that our subnet is actually live on testnet and can be tested out. We are deploying the faucet tonight, I believe. Actually, it's already live, but we'll be sharing the link tonight. And you guys can create your own smart contracts on that and test out the gas fee selective subnet features, which is helpful for us as well. And in the next 6 months, I'd say that by August, we're going to be release our first NFT collection, which is going to be playable character with unique traits and benefits to be one of the early beta adopter of the project. And by December, we'll be launching the closed beta version of the game, which will be accessible with the NFT both in August. And by January, then we are probably launching live, if everything goes well, with the public beta version of the product and open beta days that everyone can test out without buying NFTs.
Awesome. And Todd, what can we look over the next 6 months?
Yeah, a lot. This is a big inflection point for us. So this is a major, point where we're announcing this partnership with Avalanche that we're super excited about. Beyond that, on the core product side, we're rolling out more and more titles all of the time. So in the next couple weeks, you guys can pick up CNET. In its first incarnation, CNET was the world's best-selling DVD game of all time. It's movie and TV trivia. It's chock full of awesome content from everything from Iron Man to The Godfather and everything in between. It's super fun. So we're relaunching that on streaming with Mario Lopez as your host. You can buy that exclusively at Target, along with our Family Feud title. Jeopardy with Ken Jennings, Wheel of Fortune will follow, and then about another dozen games to kind of fill out our year one launch slate. And a whole bunch of stuff that I'm really excited about that I can't quite talk about yet, too. So,
all right, soon.
Stay tuned. Yeah.
Thank you so much, everyone. Let's give a round of applause for everyone coming up here. Thank you.
I'm gonna just say it. Can you grab that? I'm just gonna. Give me 1 second.
Should I tell people not to leave? Should I tell people not to leave?
We're going right inside. Here. Thank you.
How's everybody doing? That was a great panel that we just had. So let's give a round of applause to all the amazing games that we have on Avalanche. And a round of applause to our Joe Ferrara, everybody. Thank you, Joe. I'm John Nahas, VP of BD. I'll be hosting this for the next hour and a half or so. But we're really excited to welcome somebody that's been an early adopter of Avalanche, a great partner of ours from Rome Blockchain Labs, someone that I consider personally a great friend, and all of us should thank for everything he's been doing for Avalanche. JD, why don't you get on up here? I know that you have a special announcement today. Everybody, can we get a round of applause for JD, please? It says we're on Blockchain Labs, but it's JD from Banky as well, one of the first dApps on Avalanche. So JD, we're really happy to have you here today. I'll give you this one, don't worry. And I'm going to get off stage because you talk better than I do.
All right, buddy. Good afternoon, everybody. How we doing? That good? How we doing? Good? Yeah. Good first day at Avalanche House. Thank you all for showing up bright and early at 10 after 1. Just wanted to come on and make a bit of an announcement, but first, anybody familiar with Banky? Yeah, listen to that. Anybody else? Good. What about liquid staking on Banky right now? Yeah? 2, 3, 4? Okay, so what we want to talk about today, and I've got some friends that are going to come up in a couple of minutes and chat more about this, but we're really excited. Rome Blockchain Labs has partnered with Alluvial to bring institutional liquid staking to Avalanche. What that means and why that's important, we're going to talk about in more detail. But if you're not familiar with liquid staking, the ethos behind liquid staking is we want to contribute to the security and the decentralization of the network, of course, but want to give investors the opportunity to use the representative tokens in other parts of DeFi and still have access to their equity and their liquidity. And one of the biggest obstacles, I guess, to larger adoption of liquid staking has been, KYC, AML requirements, some of the institutional stuff that is required for larger participants and enterprise to also participate in the ecosystem. So we're really excited today to announce a partnership with Alluvial. And that's going to bring a very structured, kind of global access to institutional liquid staking on Avalanche. Very excited. Hopefully that gets everybody fired up here, maybe as much as I am. But yeah, there we go. Obviously listen, look at this. Everybody's still sleeping. But I'm losing my voice, so I apologize already for being nice and quick about this whole thing. But we have 3 great partners and great friends that are going to come up and chat with us about this, about the size of the market, what we're expecting, rollout plans, why Alluvial, and what the technology means for the ecosystem and crypto in general. So I'm not sure if Nahas, are you coming back up, or should I just introduce the guys? So I've got 3 partners coming up today. We've got Clay from Figment. And Mr. Evan from Coinbase Cloud. And last, but definitely not least, Mike from Alluvial. All right, just one final thought. There's a press release that's going out, I think, right now. So if you have any questions or you want to read up a little bit more on the partnership, what it means, how it's going to work, you'll probably see it all over Telegram, all over Twitter, and wherever else you find crypto news. So take a look, share, reshare, would be appreciative of that. Anyways, so to kick it off, I'm going to ask Mike a quick question. He's one of the co-founders of Alluvial. And so for those of you who have not heard of Alluvial, hopefully Mike can take a second to explain to us and kind of walk us through how Alluvial came about, why did you guys decide to build Alluvial, and kind of what's the ethos behind the product.
Sure. Hey, everyone. Thanks for having me today. Thanks, JD. So Alluvial is building an enterprise-grade liquid staking standard, and that is multi-chain. Institutions just require a higher bar in order to participate in the digital asset ecosystem. And so to what JD was saying, what does that namely mean? That means compliance and security, just a higher bar. And so the project started with my 2 co-founders, Nico and Matt, at Kiln and Figment, respectively, trying to create this institutional favorable standard. And realizing along the way, talking to people like Evan at Coinbase, the types of problems that institutions are running into, and kind of coming to this point that it's better to do this as a decentralized organization in one that is very focused on collaborating with other top-notch players in the industry. Right? And so that was kind of the birth of Alluvial. My background, I'm actually from, most recently, the Index Cooperative, which is more of an Ethereum, Polygon based project right now, and I was running institutional business there. Same thought process, institutions have a higher bar, so I'm kind of used to that. It's the same argument here. And so this is how the protocol works. There are 3 main ways to participate. You can be a validator, and so the bar to be a validator is very high, and we're working with top-notch validators, Figment and Coinbase Cloud, on day one. There are integrators, and so these are entities that service institutions. They do the KYC step that makes us different from the more crypto-native protocols that are already doing liquid staking, like Banky. And then finally, there are the tech providers. And this is where Rome Blockchain Labs comes in. So rather than try and take all of this on ourselves, the best way to extend this protocol and to do it in the most collaborative way possible is to actually go to the best, go to the experts that understand this network cold as a way to extend our API beyond our initial Ethereum implementation. We're working with teams to extend into Polkadot and now into Avalanche. This is a little background on how we came to be.
Beautiful. So obviously, one of the things that is really critical with institutional liquid staking on Avalanche is the fact that we can take deposits on the C chain and then move from the C chain through the X chain to the P chain, which is where the assets, of course, are staked. Really important here for the institutional piece of this, because most of the major centralized institutions are connected to the C chain, but not necessarily the X or the P chain for this activity. So this makes it a little bit unique on Avalanche, but the technology already exists, and we're really excited to expand that, of course, to this type of application. I'm going to move to Evan now a little bit. Maybe you can talk a little bit more about the appetite for institutional liquid staking, kind of what you guys are seeing at Coinbase Cloud, and why, obviously, it was really important to start to integrate with Alluvial and further partners.
Yeah, I would say over the past, year, we've just had more and more interest in liquid staking. It tends to be a more flexible product, providing flexibility for institutions, but also just end users. And we've seen that with the success of Benki on Avalanche and things like Lido and Ethereum. And so as we were starting to think through our position of how do we bring liquid staking to our customers, we knew that there were key concerns that we had to address. And at Bison Trails, which has transitioned into Coinbase Cloud, we built the world's largest staking platform, and a lot of our success really focused on our security posture. In the early days, we went to large exchanges, custodians. We had things like pen tests, SOC compliance, that really helped us set a bar and win a lot of that business. And so as we were starting to think about that, of how do we use that skill set, but do it in a way that is a decentralized way and also can partner with other collaborators in the ecosystem, we thought about, let's do this in a way that is Web3 native. And so we've been working with Figment and the founders of Alluvial to really try to build this enterprise-focused, security-focused protocol with the best teams and technology providers who have that security focus, but also the leading validators like Figment, who can really tell a story of, hey, come work with Alluvial. You can do all your staking in one place, which is a key concern for a lot of these exchanges, custodians. They don't want to manage 10 different vendors, and so come work with us. We're a collaborative group that has really that focus on enterprise and security.
Beautiful. So I guess, what does this mean for Avalanche? Why is this? Why are we so excited about this? Why is this something that is one of the major focuses for Rome Blockchain Labs at the moment? And really, it comes down to kind of that. At least our thesis is one of the next big inflection points for the space is bringing in more and more institutional participation, and obviously validating a network, keeping things more and more secure and more decentralized over time, incredibly important. There's a lot of demand, as Evan was talking about, and we'll release some more statistics and a lot of propaganda around this over the coming weeks, I guess, so people can start to see what this is all about. But I think it's a really important inflection point in that institutions want to find ways to participate, but currently the bar is unfortunately too low, especially for something as fundamental as staking and delegating and validating on these networks, Avalanche in particular. So looking at institutional demand, obviously we have some expectations and different things that we hope to hit over the coming years. But just objectively, if you think about the amount of institutional demand that can and will exist as a consequence of this, it's very exciting. One of the important pieces here, though, is that it is still going to remain as decentralized as possible. And that was critical through the partnership discussions and the technology integration was to maintain decentralization as much as we possibly could. Obviously, while providing a product that is accessible to institutions via KYC, AML, and certain infrastructure pieces that Alluvial and partners like Coinbase and Figment are going to provide. we really want to create that opportunity for institutions to participate, and this is one of the best ways to do so. Speaking of technologies and different types of integration, and more specifically the validator networks, what brought you guys, Figment, to the table here, and how do you view security and participation from validator sets in this product?
Yeah, I mean, the difference between proof of work and proof of stake is obviously it's not people running hardware necessarily that are securing the network. It's like people all in this room who hold AVAX and stake it. I mean, if no one here is like holding AVAX, then this isn't your house. Maybe you should buy some. But like we sit at like the third step from as a token holder. Like you have to buy the token at somewhere. You have to custody it, whether it's self-custody or through a custodian, and then you work with someone like us or another validator to stake it. And the more tokens that get staked means that the network actually becomes more secure. So like, what we really want to focus on is removing that barrier to entry once you own the token on any network that we support. And so I think the interesting thing about what Rome is doing is that most of the activity on Avalanche right now is on the C chain. And now and most custodians support the C chain, and they don't necessarily support the P chain right now. And so now we can create a system to where you get the liquid token, which is great, but every single custodian already supports that particular point where most of these assets are being custodied anyway. So removing that barrier will ultimately see more validators on the network, more AVAX being staked, and ultimately delivering a more secure network over time, which is like attractive for us.
So when looking at different partners, I'm going to go back to you, Mike. When looking at different partners and different networks, what was some of the criteria that you guys are looking for? Obviously, building an institutional grade product has some larger requirements, I think, from many different perspectives. What was some of the factors that you guys look at, not just on Avalanche, of course, but across all of the networks that you're building partnerships?
Yeah, I would say pain points on the unbonding time. I would say, an existing solution already doing liquid staking was important. Size of the network was also important, and so that's where we're starting. But the other side of it is that we're going to continue to expand onto other networks over the coming years. But it was important to start with a network like Ethereum and Avalanche and Polkadot.
I think telling that security story, it's really important to be able to look at who has a track record of excellence. And obviously, the Rome team does, and we've seen all the success on Benki. And so I think as we tell that security story to enterprises and institutions around, hey, this is a great way to stake, you provide more flexibility, and we've got some of the best teams that have track records of a year plus producing hundreds of $1 million of security. I think that's a really important part of that story.
I also think I think everyone here envisions like a multi-chain future, and even within Avalanche, like that's like at the baseline of the value proposition of the network. But you don't want that experience to become more and more confusing as more and more chains launch. There's different network architecture that exists for different ways to optimize certain transactions or use cases for blockchain technology in general. But then when you start talking about 100 or 1,000 different proof of stake networks, it gets to a point of complexity to where people just don't give a shit anymore. And so when you're talking about having alluvial, kind of setting a standard of we have done the due diligence. This is the same service that we're providing on all these other blockchains that you're interested in, then it kind of removes a barrier to entry as well, just from agreeing to the fact that this is a safe and secure place to start staking assets.
And one of the really attractive pieces about liquid staking on Avalanche, of course, is the fact that we don't have to do excessively long bonding. We don't have to lock up tokens for very long. It makes the market dynamics of the liquid staking token relative to other tokens of the ecosystem relatively constant. We're really excited about that, and one of the reasons that Avalanche is going to be one of the early blockchains launched with with Alluvial for this product is there's a big demand for that from an institutional level. You know, that they can still participate in liquid staking, they can participate in validation or security of the network, but they don't have to worry about a lot of the interesting dynamics that we're seeing, even with ETH2 staking right now, and what happened when the market took a bit of a dip, if anybody's paying attention to that. You know, that was a bit of a pain point for a lot of people, and there was some concern, I think, over how the liquid staking tokens would respond. Avalanche is a little bit more predictable. We're really excited about that. And it's also creating a lot of excitement around institutional partners. They can participate. The risk is significantly lower than many other networks. And I think we're going to see a lot of exciting demand fairly early on. I know we can't share specific partnerships or some of the big announcements that are coming pretty quick, but from an integrator standpoint, how do you see kind of this evolving? What types of partners, so to speak, will Alluvial partner with, and by extension, the liquid staking product on Avalanche? What types of partnerships can we look for? How can users and institutions expect that to look if they want to participate?
Yeah, I mean, there's a lot of opportunities to participate, like I said earlier. So I think one of the groups that we're talking to a lot today are the custodians and the exchanges who, like a Coinbase, have they have assets on their platform that aren't being staked because it's not in a liquid fashion. And as we're having those conversations, one of the things that keeps coming up is the engineering lift in order to offer something like this, offer liquid staking in general. And to Clay's point, those problems compound as you think about offering it on multiple networks. So the fact that we're doing this in this API-first approach with the best teams in liquid staking on those networks allows a custodian to very quickly, much more quickly than building it internally, offer this service to their end users. So there's a whole effort with speaking to all of the top custodians. We've been speaking, of course, with great tech provider teams, potential tech provider teams, and over time we'll also be increasing our validator set. So those three roles will just continue to expand. I mean, liquidity is also super important, so we'll be working with market makers as well. So you just hitting a lot of different places in the ecosystem. DeFi, I mean, I think one of the benefits of this that we haven't touched on is that KYC is going to happen, but similar to USDC, similar to Wrap Bitcoin, it happens through the custodian at mint and redeem. And what that means is these receipt tokens can be utilized in DeFi, can be utilized in the ecosystem, and they're free to travel. And that makes it, it gives it the opportunity to just pervade the entire digital asset ecosystem.
Yeah, and I'll just say, on the integrator side, we've talked a lot about institutional and custodian, but this is also what we believe is like a traditional retail product as well. A lot of these major exchanges, they have incredibly high bars for security around who they'll partner with, what kind of vendors they'll work with, and we think that there's an opportunity here, similar to the success we've had, is bring them an option of liquid staking across every major chain. So expect to see institutions, but also normal people that are just participating directly in the network and now making it easier for them to have these second order effects of participating in DeFi, and I think that's going to be a huge unlock for the industry.
So over the next couple of months, few months, one of the big activities, I think, for both parties here, Alluvial and Rome, is to work on early integrations on the DeFi side. Where can the liquid representative tokens actually be used beyond just staking itself? And so that's a big piece. Any partner projects in the audience, anybody that wants to reach out to us, please do, to start laying the groundwork for some of this. In terms of actual launch of the product itself, we're aiming for a Q4, Q1 product launch. Alluvial's doing the Ethereum launch first, and then it'll be a fairly fast follow with Avalanche and other networks. So we're really excited to roll that out. We've got a couple minutes left. Does anybody have any questions? Not all at once, though. Yeah, go ahead. In the hat, yeah.
I would say,
Well,
we'll just repeat the question first, just so everybody can hear. So his question was, with institutions coming in, essentially what you're suggesting is that it creates kind of excessively large participants in the ecosystem, both from a validator perspective and from a depositor perspective. And your question is, how does that impact the overall network, the security of the network, and so on?
I would say, outside of getting in the weeds on consensus design specifically to Avalanche, like just applying the Nakamoto coefficient, like Avalanche is like the largest, like most decentralized network to exist right now in the space. And Ethereum's Nakamoto coefficient for proof of work right now is 2. So 2 of the largest miners need to agree to fuck up the network to break it. I think Avalanche is like in the teens or like the mid-20s right now. So if you're comparing Avalanche to the largest network that has the largest adoption, it's definitely the most decentralized. But also, like, in the grand scheme of things, when you're looking at launching something like this, right, there's interest across the multi-chain of like this working with the providers that are running the infrastructure. So we have vested, like Figment, Coinbase Cloud have vested interest in like supporting all of Web3. And so it would be pretty ridiculous for us to act maliciously on Avalanche when we're doing something like this. But to your point, though, yes, I mean, there will be more stake on the network. But I don't see it as a huge concern at this point.
I think one of our goals is, obviously, as Mike said, we expect to increase that active set. I think one of the things that we're going to be doing in the early days is kind of putting out some objective factors around how to join the set as a validator, right? Regular pen tests, SOC compliance, things that these enterprises care about. And so we should see that set expand pretty quickly. And what we're hoping is we're actually going to raise the bar of other validators in the ecosystem to kind of meet those security standards. And then, you know, today a lot of stake actually happens in a centralized way around a lot of these exchanges and custodians, right? They use one staking provider, there's not a lot of transparency, and so we think there's a way to actually bring a little bit more transparency into the space by kind of having this all happen on chain in a decentralized and transparent way. But it's a great question, and something we're obviously very, you know, aware of and concerned in trying to drive towards.
And one final point on that. When these validators become trusted partners of Alluvial and on different networks, they are KYC'd, so they're known entities. I think that in and of itself raises the barrier to malicious participation, I would suggest. But it's a really good question, and definitely something that is top of mind. Decentralization and security is, you know, kind of the foundational principles here. But great question. I think we're going to get booted off. Anybody else have a quick one? Nothing? Good. Well, thank you all very much for your time, and looking forward to getting this launched and out into the wild.
Is this on? Okay, let's give another round of applause, guys. Figment and Coinbase, great partners. Welcome to Alluvial, and of course our native son, JD, thank you for all you do. Going from the topic of institutions now, we're going to switch over to, of course, DeFi. So I'd love to get your attention to this panel and to introduce those that will be coming up. We have Bailey Rutzel from The Defiant, who's going to be moderating this. Austin Barrick from Coin Fund, Firestorm from Dexalot, and of course Avalabs' own head of DeFi, Luigi De Meo. So round of applause for them, please.
All right. Hey, everyone. Thanks for joining us. So this is high-performance DeFi. High performance meaning better, faster, more efficient. I do not know about y'all. Nothing I do in DeFi is fast or efficient, to be fair. And it's not because the protocols are not fast and efficient. The blockchains might be, but I am very slow and methodical about how I move my coins, because I know if I screw anything up, they're gone. Vamos. And because of that, you know, those are the coins that in the next hype cycle are gonna 1000x, and I could have bought a yacht with. So I have lots of regrets already, many sleepless nights, and so I'm very careful about what I do in DeFi. Let me explain why I have so many sleepless nights. I'm Bailey Reitzel. I've been a journalist in the space since 2012. bought Bitcoin at $11. I have none of those Bitcoin still, so that's why I don't sleep very well. Many stories like that. Now I mostly program events in the crypto space, but I do a little bit of writing as well, so that's why you'll see the Defiant up there. And now, enough about me. I'll introduce my panelists. I have Austin Barak right beside me. He is a partner at CoinFund, which is a digital asset-focused investment firm. Then we have Firestorm, pretty epic name there. He is an advisor at Dexalot, and that is a decentralized exchange looking to bring a centralized look and feel to crypto, to DeFi. And then I have Luigi Denorio DeMeo. He is the director of DeFi at Ava Labs. So we're going to start with Firestorm because I want to talk about this idea of bringing a centralized look and feel to DeFi. We had talked previously over email, and you had just mentioned, look, for all of traditional finance's faults, it does work pretty well in many cases for trading. And so I guess I'd like you to sort of set the scene in terms of, I know you have history in traditional finance. What in traditional finance are you just baffled decentralized finance doesn't have?
Sure. Thank you for the question. Hi, everybody. So first of all, traditional finance has been, has had trading for a very long time, right? Trading is actually very efficient in TradFi markets in the form of centralized exchanges. The reason why we've arrived at that level of efficiency is because, we have market makers who figured out how to do these things that actually, and the trading actually takes place on central limit order book exchanges where you have an order book and people manage prices for you, basically, for the benefit of the people who want to trade. Now, this wasn't really possible with the generation 2 blockchains. Most importantly, Ethereum. And don't slaughter me, these are my opinions, but I personally believe that ETH was just too slow originally in its original form, didn't have enough capacity, didn't have enough throughput for something like an order book to exist and actually operate properly. I tried one in 2017, user experience wasn't great, and it was very expensive, right? And obviously, at the back of this, AMMs were invented, right? Uniswap. AMMs are actually the most dominant form of exchanges, also on Avalanche as well, but it's a complete different paradigm, right? And central limit order books have advantages where, when the TVLs go down, your prices don't necessarily suffer because your market makers can still actually hold really good prices even in downturns, right? So Avalanche, being Avalanche, providing the speed, the finality, the capacity, and especially the subnet capability where you can create a subnet that's a exchange on its own, now allows us to bring back the central limit order book style trading to DeFi. And from a capital efficiency perspective, I believe central limit order book style trading is the most capital efficient way to trade.
Luigi, I know you also have history in traditional finance, so what do you want to bring into DeFi from TradFi?
Yeah, it's a good question. So I would say that a lot of what traditional finance has in a lot of respects is actually quite efficient, as you mentioned, in terms of price discovery and the actual mechanics of exchanging assets. What's not efficient is this layer in between the different counterparties that is completely centralized, which allows them to extract a ton of value, create inefficiencies, and also just reduce fairness. So what I think DeFi really will bring to market over a very long amount of time is the ability to exchange in very efficient ways, the ability to transact permissionlessly. So Uniswap is the first, I think, use case of this, right? It allowed people to, transact permissionlessly amongst themselves. It allowed people to become market makers in a permissionless fashion via LPs. And what Firestorm here is talking about is a central limit order book, which is a different type of exchange, which is traditionally more efficient than an AMM. I think we started with an AMM because that's easier to code, simpler to put on chain. In a lot of respects, the user interface is more simple as well. And so now we're kind of, I think, spreading our wings, so to speak.
Yeah, and what's funny is, okay, so central limit order book, right? I think we probably all know what that means. I sort of know what that means. I'm not a trader. But Firestorm had emailed me and said he wanted to talk about AMMs versus CLOBs. CLOBS, and I was just like, what the hell is a CLOB? Like, we use so many acronyms in this space, and it's like a bit hard to understand in many ways. So I guess, did you want to add on to what Luigi was saying?
No, I think Luigi covered all the aspects. So AMMs, when they were invented, solved, actually, it's quite genius, right? It actually solved a protocol level problem on the user application itself by you no longer needed to deposit assets. You can just click a single button and swap your assets, right? That's, on the user experience side, amazing. Second, AMMs also solved the fact that maybe market makers, traditional market makers, aren't yet in this space back then, right? And now anybody could become a market maker. There's, of course, a trade-off, right? There's impermanent loss, difficult to manage positions. There is MEV that actually eats into your positions, whatever. But still, those were quite large innovations. And it moved the issue from basically the protocol level to the application layer. Now, ETH is trying to actually speed up a lot of things with its new version, new form. But we obviously have Avalanche, which gave us the capability to build and launch a centralized exchange. Another example, and just so that I'm not just shilling my own project, another example, a very successful project is DYDX, right? They actually deployed on an L2 solution, and it's been so far the most successful central limit order book exchange, which is in DeFi as well. So, there are multiple innovations that I think the trading and the capital efficiency side is stronger on the central limit order book side. The UX side has and still is much more stronger on the AMM side.
Yeah, that's fair. And we'll get into a little bit more of that as well. Austin, I want to pass it to you. Like, how much, as an investor, how much do these design decisions and user experience and the way people build user experience affect what you invest in? And I ask that, I know it kind of sounds like a silly question, but I ask because there's a really high threshold for handling inconveniences in Web3. Like, we all just kind of do it and don't mind it for some reason. So yeah, I guess how much does that go into your investment thesis?
Yeah, that's a really good question, because in an open source environment, the moats are a lot smaller than you would see typically in Web 2. So what it typically comes down to is the community that you build, and a lot of that centers around the user experience. One of the reasons why Uniswap is still, one of the largest players in swaps and has the majority of market share, at least on ETH, is because it was just very, very easy to use at a time when crypto hasn't always been very easy to use. And I think that's something that, while people are comfortable being uncomfortable and jumping through a whole bunch of hoops to use DeFi today, that only allows us to get the first million users. But to get to 100 million users, or to get to 500 million, or to get even level of penetration of mobile phones or internet usage today, you have to make it a whole bunch easier. And I think that's why this is really important.
Yeah, to be fair, I liked crypto when it was really small, and it was easier to understand. So if we get to 100 million users, it's going to be complex. I want to stay with you. Do you have Avalanche companies in your portfolio, in the coin fund portfolio?
We do have Avalanche companies in our portfolio, yep.
Okay, I was kind of looking through the portfolio and just sort of making sure, but how much does what blockchain they're using affect your investment decisions as well? And I guess I ask because there's a lot of layer 2s that sort of function on this same thesis of like better, faster, more throughput, maybe better security.
Yeah, so I think, there's a couple things to unpack there, but transaction speed as one of them is something that I think is becoming increasingly less relevant. And there's a whole bunch of solutions to scale and different approaches that different ecosystems are taking. But I think what's more important is the way you scale and the flexibility that you can have when you scale. And one of the things that I find particularly attractive about Avalanche is the subnet architecture and how that allows teams to build and really, really easily build, which is an important part of that, application-specific chains that can have high throughput, but also have very fast finality. And that's the one thing that's sometimes missing in the transaction per second discussion is, how quickly a transaction is finalized, and being able to finalize a transaction within a block is really important, especially as you onboard more traditional financial applications and any sort of kind of application where there's real value at stake. So one of the companies, for example, that we've invested in, it makes it easier for subnets to bootstrap their validator set. But I think that core infrastructure is one of the reasons why we're really bullish on Avalanche and the ecosystem developing there.
Luigi, I wanted you to touch on that as well, and just in this broader context of like a multi-chain future, right? And I think that narrative is moving more towards the modular blockchain thesis, and so that's nice for the subnets, for the Avalanche's build. But just talk about why that's so important and how Avalanche itself is looking at that multi-chain future.
Yeah, I mean, I think Avalanche has been pretty consistent, probably since the initial white paper dropped, that horizontal scaling was going to be the way that we were going to achieve scale, and vertical scaling is much harder. And so the subnet architecture, what it allows is a very low-level programming environment where either applications or sectors, it could be a niche sector like gaming, for example, could deploy their own environment that, and in the future this could be permissionless, that they can coalesce around, right? And because of that, they're not interrupted by other people's activities. So traditionally speaking, if you are on Facebook, for example, the load on Google doesn't necessarily disrupt your activity, all else equal. So I think this is kind of like how we're taking this approach on Avalanche, that an NFT drop on the C chain shouldn't disrupt Dexalot's subnet by any means. And this is kind of the issues that we've seen on Ethereum and Solana and on the Avalanche C chain at times as well. So that's the approach we've taken. We also think subnets allow really interesting economies to be built because you can customize the gas token of your subnet. You can customize the staking dynamics in terms of the validators that validate your subnet. You just have a lot more full of a toolbox. And so I don't expect that applications that are looking for product market fit on day one, we'll be deploying subnets ad nauseum. I expect applications that have product market fit to, kind of do what DYDX is doing and go into a Cosmos zone, right? Because they view that environment as being sovereign and their own and much more customizable. And so I kind of think that that's what Avalanche is going to provide. So subnets provide a lot more than I think what's out there in terms of other blockchains in this element. They are VM agnostic. You can run a custom VM for whatever your use case is, or you can use Subnet EVM, which is an SDK we're developing, we're continuing to iterate on, that continuously makes deploying your own EVM chains really easy. So I think we'll continue to improve on this. It's been a very short amount of time, and I'm very excited about that future.
How many people are using subnets right now?
There's like 2 active subnets, which the first one deployed in I think it was April, so they're quite young. Yeah. I think it's probably in terms of monthly active users, 60 or 70,000 or something like that.
Okay.
Yeah, which is unfortunately a large percentage of crypto.
Yeah, fair enough. Fair enough. Firestorm, did you want to add on to that?
I was just going to say, it's not related to the user count, but having a TradFi background allowed me to see sort of the perspective on the old world, if you will, and when the old world, old guard, TradFi, whatever you want to call them, when they look at these new technologies, the way they approach it is, how do I put it in my own sandbox with my own custom rules, with my own stuff, right? The subnet architecture is literally perfect for it, right? It's not like you can go to an Ethereum L2 and customize it for yourself. You can only really do it with something as flexible as a subnet on Avalanche or some of the other competitors as well. But this approach, in my opinion, is going to be a lot better fit for the institutional world, where people are going to be slower and they're going to require custom and specific rules to be applied for the environment. I know there's one example, there's the institutional subnet that, the Avalabs team is working on. It's a great example for it, right? Every bank out there wants to apply their own KYC rules or their own capital rules, etc. And having this super custom toolbox is going to work well for them, while, a very generalized solution is not going to, in my opinion.
Okay.
No, I was just going to touch one thing on that. I think it's important, as he mentioned, with respect to institutions, to understand that a lot of them want environments that are not private but are permissioned, and a subnet can be programmed in that fashion, right? They do want some control, whether it's jurisdiction or other elements as well. So.
Yeah, I don't want to go way far down this hole that I'm about to go into, but I guess the argument there is just like, why are we rebuilding this architecture for institutions, and what are they going to get out of it that is better, faster, stronger, more high performant than what they have now?
Yeah, so what blockchains are really good at is being transparent, and they don't have that in the traditional world. So I think the recent events that we've seen all across crypto in terms of under-collateralized lending across CeFi institutions, what we've seen there is effectively black box institutions that you had no idea in terms of what the assets and liabilities were. When the issues came, it was pretty clear who was swimming without shorts on, right? So in DeFi, that's not what happened. It was very clear what the protocol had in terms of assets and liabilities, and it's because of that transparency that that blockchains provide that I think institutions can leverage that. Now, whether or not they will find that interesting for their businesses, I think is something that is a valid question, and but I do think they understand that avoiding it is probably not going to be long-term possible for them.
Yeah, sure.
So transparency, right? Think about it from a regulator's perspective in finance. They constantly bombard, large banks about what did you do at this specific time on this exchange? What is your activity? Prove to me that it's not nefarious. Prove to me that you're not doing some of the things I ban you to do, right? When you move this activity to the blockchain, they no longer need to go to the bank and ask. They themselves can build the tools or hire the people that do the analysis and show them, right? I think like the transparency aspect is huge. And also on the institutional side, think of it this way, right? If you have an algorithmic execution platform that you built, you bought servers, you had many years of software development, you built various tools around it, and you deployed it onto your own hardware. Now, when you move the stuff to the blockchain, you only have the software, and the actual infrastructure is maintained by the validators, the miners, whoever are operating the network. It's a huge cost savings, actually. We don't really talk about it as much, but instead of deploying $50 million to build a market-making system, now I actually can cut that cost in half and just focus on the software development and outsource the infrastructure to the blockchain. I think those are like huge, huge benefits for institutions to move on to the blockchain.
I'm going to back out of this hole, but I do want to talk about this more. And also because if there are developers here, do you want to develop on a blockchain that the banks are using? Like only banks are using? There might not be developers here. I just am like, if I was a developer, I'd be like, nah, I don't want to do that. I want to build something that is different than the system that we currently have, right? Anyway, backing out of that hole.
Just one thing on that point. I think that's the really exciting thing about what's being built here is you have that flexibility. So you can build financial products for kind of traditional financial players, or you could build something that's completely new, and you could have your own subnet environment, or you could build on the C chain. You could build interoperability solutions that connect it all together. So there's just a really wide surface area.
It's fair, yeah. I'm going to stay with you, Austin, because I feel like you haven't talked a lot. And we don't have much time. Like, what's going on? I think they're speeding up our clock. But so what is your vision of DeFi based on like who you've invested in and the companies that you're looking at investing in? What does that 10-year DeFi protocol look like?
Yeah, that's a great question, and also, it's thinking 10 years in the future in crypto is really hard, and
it's true.
And it's
okay,
wild.
5 minutes from now. What is your?
It's wild to think that DeFi summer, when governance tokens were only really becoming a thing, that was only 2 years ago. It feels like a lifetime ago. But one of the things that I think is really unique about DeFi versus kind of traditional finance or like kind of centralized finance use cases is, so you have the transparency, you have global access, you have permissionlessness, you have censorship resistance, but also one of the really core elements on a product side is you have composability. So you can allow all of these different financial products and all of these different tools to interact with each other and layer on and kind of find different opportunities to earn yield or to participate in different economies that aren't really possible when you have these siloed ecosystems. So I think we'll see more and more DeFi protocols building together, where we're already starting to see that, where you can kind of provide liquidity on an AMM, take that LP position, collateralize it to borrow capital, to then deposit in a yield aggregator. And you can do a whole bunch of different things, but I think that grows. And one of there's a couple use cases in traditional finance that haven't grown as much in DeFi, and I think it's just waiting for the right opportunity as far as the underlying infrastructure and pulling in large enough players, and that's futures and options. So really excited to see growth there, because if you look at kind of the size of derivatives markets in traditional finance versus spot markets, it's an order of magnitude larger, and it's actually inverted in crypto, and I think we'll see that shift over time. And there's been some really amazing teams building in options and derivatives, but it's still really early, and I think some of the dependencies on transaction speed and throughput and finality and customizability, we're only getting to that point where they have the tools that they need to get there. So it'll be exciting to see. I don't know if I actually answered your question of where things will be in 10 years, but those are the things that I'm excited about.
I don't really expect anybody to fully answer my questions when I'm up here. Firestorm, I want same question to you. Like, what does it look like in several years? And I guess for you specifically, as the advisor at Dexalot, are you telling them to think more multi-chain than just Avalanche?
So, I mean, yes and no, right? Even I think the good folks of Avalabs understand that we're going to have a multi-chain future, and I don't mean subnets, right? I've heard Gun say this many times. There's going to be solutions and applications deployed across, many chains. The one thing we are absolutely thinking about is our subnets. If you think about subnets at a very, very high level, they are a separate chain to the C chain. C chain is a subnet as well, right? Technically, which means that as long as we have good bridging, we could actually use our subnet still to do the actual execution with low cost, quick finality, high throughput, while allowing people in other chains to do the trading, right? We could have a bridge that just wraps that user experience into a single transaction, and that happens. So in that sense, yes, we are definitely thinking multi-chain. Going to the other part of your question, I think in the next 10 years, the biggest thing that will happen, besides the products, etc., is people will understand the DeFi Legos that we ourselves, the folks here, are comfortable with. A much larger amount of people in the world will understand it, right? The typical simplest example I give is, we have Benki on Avalanche, right? I could show people that I can pull out a loan in 3 seconds with one click. You can't do that with a bank. Getting any kind of loan takes 90 days, a very cumbersome process, and you can do that with Benki. And that's a very powerful real-life application. I tried to purchase a house with this. My offer wasn't accepted, but the experience, the example is still very powerful. And a lot of people out there still don't know it. I feel like these types of use cases will actually become very common, and that's going to be the most important change.
Go ahead.
One other thing, kind of just building on that, I think one of the most exciting innovations that we'll see is truly accessible global markets. And, you sometimes, being in the US, take for granted that it's really easy to invest in stocks, or lending is actually not very easy. So that's something that DeFi clearly solves. But just being able to take the assets that you have and either earn income or grow that wealth over time in many places around the world, that's actually not very difficult. Not very easy. So to be able to build a financial system where anyone can easily invest and grow their wealth is really important, and I think one of the core tenets of DeFi.
Luigi, I want to give you a chance to talk about your vision as well.
My 10-year plan?
Yeah, you have 16 seconds though, so just FYI.
We're going to make it? No.
We're going to make it.
Yeah, we are going to make it. No. So real quick, what I would just say is, like, I think there's two real avenues for DeFi. I think there is the one where it's focused on trading, replacing a lot of the traditional finance blocks and making them in a decentralized manner. And I think that will happen, and you'll see a bunch of unicorns develop that will, I actually do think, take away some of what traditional finance has. And then I think there's the other part of DeFi, which a lot of people don't talk about, where it's going to be effectively the top of the funnel for all the other use cases in crypto. People will know that they're playing with DeFi type applications, but they're using it to facilitate the other applications, whether it be social media, gaming, et cetera. So that's my fast answer.
Actually, that was pretty good. We're only a little bit over. Thank you so much for listening, and thank you very much to our panelists.
Thank you, Bailey. Thanks, man. Thank you. Another round of applause, everybody, for Bailey, Luigi, Austin, and Firestorm. Those are some great early panels to get the day started. With that, we're going to take a break for 35 minutes until 2:35. There's a ton of great food outside. Grab some drinks, meet, network, have some fun, and we'll be back at 2:30 to continue the programming for the day. Thanks.
Okay. Hello, hello. All right, it's me again, guys. For those who haven't met me, I'm Devin Ferreira. I'm the CMO here at Avalanche, and we are now in the thick of it. We decided to do some light programming and talk about some fun topics. Of course, this is one that's on everybody's mind, but very excited to introduce you to our moderator and panelists to talk about fundraising in a bear market. I can't wait to see what these guys come up with. So please welcome to the stage Nina Bambisheva from Forbes, our very own Lydia Chu, we got Tom Schmidt from Dragonfly, and Travis Scher from North Island Ventures. Enjoy.
Hi everyone, thanks for coming. Thank you guys for being here with us. So why don't we go around and briefly introduce ourselves. I'll start. I'm Nina, I'm a crypto reporter with Forbes. Lydia.
Hey everyone, I'm Lydia Chu. I am Vice President of Business Development at Avalabs, so co-leading the biz dev team as well as the Blizzard Fund, which is an Avalanche ecosystem fund.
Hey everyone, I'm Tom Schmidt. I'm a general partner at Dragonfly Capital. We're a global crypto venture fund.
Hi, I'm Travis Scher. I'm one of the co-founders of a crypto-focused investment firm called North Island Ventures. We're based here in New York, and we do primarily early-stage investments in crypto blockchain startups, but we also do investments in publicly traded crypto assets.
All right, perfect. So last year we saw crazy rounds, high sky valuations. Deal making isn't stopping, obviously, but the environment is very different. And I'm curious, what are you guys as investors looking for today versus last year?
I can start. So last year we saw a lot of projects that were building on existing ideas, existing protocols, forks, modified forks. And then first half of 2021 was very much DeFi driven. And then second half, what we saw on Avalanche was very gaming driven. So this really led to a proliferation of play to earn games as well, and what people regard as unsustainable tokenomics. And I think we're just going to jump right into it. But coming into this year, I think we're excited to see folks rethink those models and come up with more sustainable economics for their protocol, kind of drive growth with their tokens and align that more with actual usage of their protocol.
Yeah, I don't think our sector focus or criteria has changed too much, actually. Like, we still do a little bit of everything. We do early DeFi protocols, we do NFT infrastructure, we do layer 1s, layer 2s, CeFi infrastructure. I think for us, especially now, we really look for teams that have organic product market fit. It's always been something that we look at when we look at data, especially for something that's later stage. But especially true when yields are down and you have to sort of find something that actually has users that's solving a real problem versus something that may have relied too much on incentives. I think additionally, you really want teams that have that kind of focus, that have been diligent through the bull market in terms of managing burn, staying focused on shipping product, not focused on vanity metrics or something like that. So some things are kind of the same, but some things are different. I think the only thing that's maybe different is sort of later stage deals where teams that maybe raised like a really high valuation last year are now seeking more capital, and unfortunately maybe the market's contracted, and so those are kind of the tough negotiations to have, but seed is still getting done pretty rapidly, I would say, just at sort of where the market clearing price is now.
So on the one hand, I would say how we look at investment opportunities hasn't changed at all. We do primarily seed stage investing, and so you're always thinking 5 years into the future. You're looking at the quality of the team, the quality of the idea, and the deal terms. But on the other hand, I do think that a lot has changed. I think that last year, based on the infrastructure that was available, we did sort of reach some of the limits of what was possible on blockchains with the ideas that were out there. So if you look at DeFi 1.0, which was based primarily on hype and speculation, we took that about as far as it could go, and in its logical extremes, it led to fragile systems that have completely collapsed. If you look at the NFT market, there was a lot of experimentation with 2D static images that people got really excited about buying and trading. And again, I think that's gone about as far as it can. So looking to the future now, what we're really looking for is more robust, more secure, more scalable infrastructure. And on top of that, we're looking for applications that can solve problems in the real world. And some of those will take some of the primitives that we've built in DeFi and NFTs and apply those to areas that can actually improve people's lives. And it's not going to be as easy as building, some of the speculation-based traction that we saw last year. And we're also looking for just new, innovative applications of this technology. I don't really have a strong opinion on this, but one of the trends that some people are excited about is this proof of physical work concept. So the idea that, you could use some of the ideas behind Helium, for example, to create these incentivized networks to collect a bunch of data and offer a service all over the world. So that's really how we're looking at things today.
All right, so thank you. Before we dive into the specifics, and particularly some of the verticals that took off last year, DeFi, NFTs, I just want to take a step back and ask you, what do you think should be, the guiding principles for any founder to navigate the turbulence, not just specific to this bear market, but in general?
The guidance for founders now shouldn't really deviate that much from when it's a better or bull market. It's, build a business that's positioned to grow and succeed, and that really means being cognizant of where you need to hire, where you need to spend, and also really build on ideas that, I think we mentioned here, where things that make the world better, but also have a real use case, right? Where we're trying to bring mainstream adoption to blockchain, and so at least at Blizzard and trying to grow the Avalanche ecosystem, where we're definitely keeping an eye on things that are more than just kind of like bringing yield in an ever like growing DeFi market in that sense. So not much. I don't think there's much that's different, except keep your head down and build.
What are your thoughts, Tom?
Yeah, I think a lot of the startup advice that is classic is classic for a reason. I think the main difference in crypto founders is you get a lot of people who are very idealistic, both in terms of having some sort of grand cathedral or blueprint that they want to build, because it's sort of their ideal vision of what the world should look like, or they have sort of a misunderstanding of people's values and want to build something that they think should exist, but no one actually wants or exists today. And so I think for us, we always have a bias towards small teams that ship fast and use that to iterate, which is somewhat tricky in crypto, given sort of the complexities of smart contract development or blockchain development broadly, but I think is actually is possible for sort of the right set of team members. And so I think that's probably the strongest indicator for us, or highest signal indicator for us of a team that is likely going to be successful in the long term is, do you ship reliably? Do you look at the data? Do you see what your people are doing and using that to inform the product roadmap?
Yeah, so as it pertains to fundraising, what I'm telling our portfolio companies and the advice I would give to anybody building a company now is you should assume that things will get worse before they get better and stay bad for a while. It may not be what happens, but the nature of these crashes, the nature of these bear markets is they tend to take a lot longer than 6 months to bottom out and turn around. And so from a strategic perspective, if you have the opportunity to raise capital now, you should do it. From a budgeting perspective, you should make sure that you have a minimum of 12 months of runway to the extent that that's possible. Now is not the time to increase your burn and assume that you're going to raise your next round at the end of this year, because as much as things have changed in the venture markets, at the early stage there is still money available, and at the late stages things have completely dried up. And if you look at sort of the shape of the capital markets, the money comes from large LPs, and then it gets committed to venture funds that deploy it over 3 years. The large LPs are having to take stock of massive changes in their balance sheets, and so the VCs who were flush with cash and still have, another year of capital to deploy, that's going to start to dry up as well. So, you know, it's a bit pessimistic, but I tell everybody to really assume the worst right now.
Travis, thanks for mentioning that, because I think, yeah, for those who won't be fundraising for whatever reason during the next few months, you mentioned budgeting. So do you guys have anything to add in terms of how these startups can best use their capital, the capital that they have on hand, and any tips in terms of operating, things like that?
Yeah, I think the main goal is to just be really cognizant of where your expenses are and cut the non-essential things. It's I think even beyond 12 months, it might even be 24 months sometimes. You know, these markets are never that quick to recover. And on top of that, you know, really figure out what your use case is and how your go-to-market can evolve in these more turbulent times. You know, if it's growing your engineering, then, you know, focus on that. If you realize you have the product, right, and then you really need to get branding or get some awareness, you know, focus on the marketing, get the word out, and get product market fit. It's a different market, and I would say just kind of figure out where you really want to focus, and you can't be everything to everyone, and just kind of be ready for more than 12 months, I would say, actually.
Yeah, I agree. It's like, you know, have the runway that you need. I think crypto startups are somewhat weird in that, like, I don't necessarily think even increasing headcount has like a very strong positive correlation with outcomes. We see two teams working on the same, you know, working the same market and just totally different market shares, totally different product outcomes, often with like a, you know, several-fold difference in terms of employees. And so I think like staying lean is actually very good and very feasible, just due to the kind of scale that working in crypto can kind of give to you. But I think it's also a component of staying focused. I see a lot of teams that see these little things floating around them of, oh, we could ship this product, or we can make a little revenue doing this. And I think those are always, those are sort of you know, little mini anchors that always sort of slow you down and drag you down. And I think staying focused on you know, one particular thing, shipping it, testing it, see what the feedback looks like, and iterating is like kind of the way to do it. I used to lead product at 0x for 2 years, sort of during the bear market when nobody was trading on DEXs. And I think part of the reason why we were, you know, one of the few successful teams out of the 2017, you know, sort of vintage was like just for that reason, where we didn't ship a bunch of superfluous stuff. It was ship one thing, see if it works, look at the data, and then just keep iterating on it. And I think that's kind of the formula for success.
Right, and kind of turning that around and focusing on what you guys do. So obviously fundamentals are fundamentals, and we saw some huge funds from Dragonfly, from Andreessen. So it looks like there is a lot of dry powder still on the table, but deal making is slowing, at least that's what my inbox tells me. So I'm just wondering, how are you reprioritizing, perhaps, if at all?
Yeah, you know, it's definitely going to take longer for founders who are looking to fundraise. That's just what the market is. There is still dry powder out there. VCs are still taking meetings. You know, it's just a question of how much longer these meetings take and what is the likelihood that they're actually looking to deploy capital. It's probably not a near-term thing where VCs are going to all of a sudden say, like, okay, I think the market is settled. I'm ready to start deploying this. You know, funds have long-term durations over, you know, the course of multiple years. So it's just going to be very much, even at Blizzard, we're continuing to participate in rounds, but things are taking longer just because we're being more cognizant of the market. And we also want to make sure that the funds or the teams that are left building right now, that they are also keeping like a longer term plan in mind and looking to be here after 5 years, right? Like that's kind of how we're looking at it.
Yeah, so we just closed a $650 million fund for venture. So it's a nice position to be in, where we have a lot of cash and can find the best teams and work with them. I don't think our strategy has actually changed too much. Venture is sort of venture, where you back teams in early stages and you help them build, and it's kind of like getting married, and hopefully many, many years later, you know, things work out. I think for us, as Lydia was saying, like, it's nice that the deal pace has slowed down a little bit, where it used to be, hey, we need a term sheet within 24 hours because we have 4 other term sheets. now we get to know the team a little bit better, look through their data room, do our own diligence, talk to customers, like, really kind of do classic sort of venture work, which was harder to do in 2021. But yeah, I mean, as people have been saying, like, seed is still getting done, and we're still deploying. It's just a question of like, where later stage comes in. But even all these teams don't even need to raise. We see investor updates from teams that have 6, 7 years of runway because the team is so lean. They were able to raise cash last year, and so it's a very interesting dynamic in the venture space right now.
Yeah, I would say in terms of how we are, refocusing and reprioritizing, we were never big on this, but we really don't want to make a lot of investments that are based on the premise that there's going to be more and more speculation and trading in crypto over the next year. I think that we're much more interested in, some of the infrastructure that we believe can survive and persist and win some of these markets over 5 to 10 years, and B, some of these products that are unlocking entirely new markets. I think we're still seeing a lot of decks from folks who are trying to build a better Uniswap or a better DYDX or Compound, and I think those really don't look very interesting right now.
Travis, you mentioned kind of speculation. I think there's a new understanding in the market, especially for new entrants. And after the Terra Luna collapse, we saw conversations, are algorithmic stablecoins dead? Now with what's going on with Voyager, with Celsius, there's a lot more questions around CeFi and whether DeFi can really prove itself. So I'm curious, what's your takeaway from these debacles, and really, did that lead you into thinking, oh, there are certain types of projects that I'm definitely not going to touch in the next few months, or just exercise more caution around?
Yeah, I think what's kind of ironic and unfortunate is that the whole premise of this technology was that we would create these resilient, transparent, automatically executing systems for moving money around the world. And what got built on top of that were A, some obviously fragile systems, and B, an entire shadow banking system. And I think what people are now clear on is that just because something is based on blockchain or crypto, or just because a company is in the crypto or blockchain space, it can be, as fragile as anything that's ever existed in traditional finance. And I think that, there's been a lot of money lost, and this will set the industry back in some ways, but the scale of the losses is totally manageable, and I'm optimistic that the lessons learned will lead to the next wave of financial infrastructure that's being built here that actually is more secure, resilient, that people understand how to look through the transparency that's available. And a lot of those protocols and primitives do already exist. I mean, most of DeFi has held up incredibly well during this downturn, but I'm hopeful that those are the lessons learned here.
Yeah, I feel like as someone who's been in DeFi before DeFi was DeFi, it's extremely validating actually kind of see what's happened where, not a single user dollar was lost in Aave, Compound, or Maker. It's people basically building a 08 style, thank you, GFC style thing. But instead of using mortgage-backed securities, they're using crypto. But it's the same kind of problems as back then that DeFi was built to solve. And that's kind of what you're seeing, right? There's all these negotiations around who's senior, who's junior in these bankruptcy resettlements. But who's actually the most senior is DeFi. They're getting paid back before anybody else because the smart contracts specify that. And so I agree. I think like some stuff was unsustainable. I think overall, there's probably going to be sort of a come to Jesus moment in CeFi around what does sort of the next wave of CeFi look like. But if anything, DeFi has been unbelievably resilient, and I think it's made me much more convicted on it.
Yeah, I can just repeat everything that these two said. CeFi isn't DeFi, and it was really just a new name for banks that are functioning outside of blockchain. They just use assets, right? They just use the crypto instead of actually building on-chain. And DeFi showed that it was still resilient, it still works, and you have the transparency that you actually didn't have with any of these CeFi institutions. Like all of these filings coming out now, and everyone is kind of shocked that this was what was happening behind the scenes. So I think as far as the question of things to not touch, I think that's probably not fair to teams or devs who are building new projects. I feel like, well, for us, we are looking at teams that are building on Avalanche and using the platform in an integral way. So that automatically kind of removes the more centralized, the CeFi solutions out of the picture. But at the same time, the innovation that may be happening in algo stablecoins, for as an example, we don't want to preclude any new projects or new ideas. So I think it's probably a good idea to give everyone a fair shake and just evaluate everyone on the team and the idea from the outset.
Right. We have a few minutes left, so I want to focus on what you guys do at Avalabs because, yeah, you mentioned Blizzard. The Avalanche Foundation also launched these huge incentive programs like the Avalanche Rush, Multiverse, which were very successful in drawing growth to the ecosystem. So I'm wondering, in the next few months, how are you thinking about running these programs, the fund, and what should we expect from you going forward?
We've been very thoughtful about how we structure these programs and how we position them as well. Last year was Rush. We were very focused on building out the DeFi ecosystem. And then we rolled out Multiverse because we were really focused on bringing subnets to market and getting product market fit for subnets and showing that this will help Avalanche scale and scalability is here for blockchain. So as far as the next few months go, actually on the topic of strategic fundraising, maybe it's not going to venture if you don't have to. Maybe it's exploring incentive programs, exploring grants, exploring what foundations are offering outside of investment dollars. But we've been very thoughtful, and we'll continue to deploy these incentive programs where it makes sense. We're not stopping, and as far as what future initiatives look like, I think that really is a more top-down strategy conversation, but we're very focused on subnets right now. So we'll continue to think about how to bring more adoption to Avalanche and use incentive programs to drive that. But I don't think there's nothing to announce right now.
All right, we'll be on the lookout. So my last question for you guys would be, and this is something that we were talking about in the beginning with DeFi, NFTs, DAOs. This really what drove the last bull market. So how are you looking at that today, this year?
Like what are we looking to invest in?
Yeah.
I think, for us, it's a lot of these same themes, but they're just going to look a little bit different, which is kind of what we've seen time and time again, where a lot of the ideas in crypto actually just get recycled. I mean, a lot of the stuff was on Bitcoin talk back in like 2011, and now finally the market is mature, the tech is mature, the people here, the capital is here to make something like that work. I think for us going forward, I think there's like some ideas that we have, some things that we like that we'd like to fund, and increasingly we are, but they look a little bit different than how things look today. They look more about funding real-world use cases. They look more about doing consumer application crossovers. Even things like NFTs have gone through many different cycles, where it used to be about celebrities doing NFT drops on the Nifty Gateway to these PFP collections to these community-owned projects. And so a lot of the times you'll see the same idea replicated with something fresh, and that's kind of what we're looking to fund.
All right, Travis, do you want to wrap up?
Yeah, so I'd say as it relates to those three categories, in DeFi, what we've proven is you can create these software protocols that replace financial intermediaries. And I think, just to hammer home the point, during this downturn, many of those have proven to be extremely robust. And most people are talking about the failures, but those are big successes. And now the question is, how can we take those, cross the chasm, and solve problems in the real world? So we're looking for companies that are doing that. In the NFT space, I think we've proven that there is consumer demand for digital assets, and that people understand what digital assets are and the value that you can create when you have provable scarcity. And the potential number of applications here is infinite. But what's interesting to us is moving beyond these static 2D images to NFTs that are more interactive, have more utility, and that could be as simple as, you know, an item in a game, or it could be something that gives you the right to participate in the creation of some media experience. I mean, the possibilities are endless. So there, we're looking for, again, companies that are building experiences that are much more interactive than the last wave. In the DAO space, I don't really feel that's had its sort of proof of concept moment. I mean, the closest thing we had really was like Constitution DAO, which was barely a DAO. It was a lot of fun. So there, I think, like there's a lot of infrastructure that needs to get built around, you know, creation, discovery, participation, et cetera. There's a ton of companies doing that. We haven't invested any because there's so many. It's hard to pick. But you know, I do believe that the core idea there is perhaps the most interesting in crypto, perhaps the most transformative, and if it works, I think that these decentralized organizations that can aggregate capital and talent can really go on to solve some of the biggest problems in the world. And so, you know, we're super excited about that, but it's perhaps a bit longer term.
All right, thank you. Yeah, well, time to build. VCs are still taking meetings, so thank you all for joining us and enjoy the rest of the event. Thank you.
Great. All right, thank you very much to the panelists. We're going to keep things rolling here, guys, and we're going to roll straight into our next panel as soon as we finish the photo op. So we've assembled a really nice group here to talk about slightly different focus. We're going to be thinking about staking. And we've assembled a nice panel of people from Web3 infrastructure and the staking industry to talk about the opportunities and the pitfalls of staking in this environment. So, one sec. All right, I'm going to keep going. Did anybody try the sliders, by the way? No? No sliders? There's sliders, yeah. There's sliders. They're banging. All right, we're going to take a second, guys, and we'll bring them up in a minute. Just give me 30. Technical difficulties. 1 second.
We're having some. Your mic is fine. We need an extra one for that. No, it's a different frequency.
Okay, after that false start, let's try that again. So, please welcome to the stage from Decrypt, our moderator, Stacey Elliott. Joining her up here will be Victor Bunin from Coinbase Cloud.
Hello.
We got Greg Gobman from Anchor, good friends of the network. Parker Firebach from Figment, and rounding out the roster, strong roster, Anna Vladi from Metal. Thanks, everybody.
Thank you. Is this on? Yeah.
Hello.
Hey, everybody.
Hello, hello. Lots of bright lights.
Yeah, I know. Comfy couches.
I feel like I'm on
the spot. Hello, New York. All right. So welcome to staking, the pros and cons. So we're going to hit on a few different kinds of staking, a little bit of staking versus staking. You know, depending on where you are within crypto, staking might mean you're just trying to plunk down your assets and make some, you know, sweet yield, or that you're actually becoming a validator on a network. So we're going to try to kind of cover the gamut today. So I want to start with Greg. We talked a little bit yesterday, and we're going to kind of try to go over liquid staking, and let's just start there kind of as a waypoint, how staking works, and why don't you kind of walk us through that a bit?
Sure. So traditional staking, for those of you who don't know, there's native tokens on all these L1s, and the way that they Secure their network is you stake the local token, the native token to that network, and you earn an inflation reward, typically between 5 to 10%, AVAX being one of the best places to stake your token, and I think it's closer to 10%. And with liquid staking, you take traditional staking where you get that, you stake your token, you get the 10%, but you also get a liquid staking token back. And the idea is that this liquid staking, kind of like an IOU to your initial staking, you can then use that IOU token in a lot of different places to get a loan, let's say, would be like the most common thing that people would think you would want to do for that. Or do like DeFi 2.0 stuff. And so liquid staking offers this new realm of what can I do on top of staking. It's a very interesting new way to look at staking as a platform for doing more. But used poorly, like with something like the old Luna protocol and how that stuff all worked, it can also be disastrous because it leads complexity on top of things. So it's an interesting thing, but also has to be used like with great power comes great responsibility.
And then talk us through a little bit of the pros and cons. I mean, you kind of got it there, mentioning Luna.
Yeah, and so for those of you who don't know, ANKR, the company I work for, is one of the large infrastructure providers in the space. Like these guys, we all do a lot of the backbone stuff that you don't see. And so where ANKR, or Anchor, also kind of is the leader is in liquid staking. So we've brought liquid staking to a lot of different protocols. We're the first to bring it to, we were actually first to Ethereum before Lido. We're the first to BNB. We're the first to AVAX. We're the first to Polygon. And so we've built out the infrastructure for doing liquid staking things and building liquid staking on top of these other platforms. We see it as a very big growth part of the market, of the staking market. Of course, staking is massive. Liquid staking is not nearly as big for it currently, but I think our belief is that it offers a lot of potential for where big finance will eventually go, where with liquid staking you can earn an extra like 1 or 2% on top of staking. And so once billions of dollars comes into the market and things open up, liquid staking will be something that gets used in a lot more interesting ways.
And then real quick before we jump into some of the other types of staking that can happen, what do you think gets us there to having all that money come into the market? What gets us so that this is a lot bigger?
I mean, it's always regulation, right? Like the big money can't come in until it's safe and secure. Staking will for sure be one of the main ways that they do come in. Institutional staking, Anchor really doesn't do institutional staking. I believe you guys do, and that's a huge part of the market. That's kind of, I mean, if there was a probably big thing that we should probably move into, but it's a lot of work to set all that up, and kudos to you guys for having the regulatory and frameworks for doing that. That's a great part of the market. And I think as more institutions come in, we're all like play money compared to them at the end of the day. Like even though we're like, this is huge for all of us, but like there's like titans of the world, there's like masters of the universe that like really play with the money, and that's when those guys come in.
Okay, so that's a nice segue for institutions. So Parker, Victor, I think we're gonna jump over to you guys. So talk to us a little bit about these other types of staking, like what it is to be a validator and what you're looking for in protocols. I don't know which one of you wants to get started.
Yeah, so I work for Figment. We're a primary provider. We just like exclusively interact with that layer. We work with a lot of liquid staking providers and help launch Alluvial, which we're working on with Coinbase and a number of other parties. But the main idea behind what we do is we provide the backbone for how it is that blockchains can actually function. So they kind of don't work without us. And the big value prop there is actually being able to secure all the transactions that live on top of it, right? So when you stake to a validator, what you're doing is you're testing to the ability of that validator to perform the function that it's there to do. So in that regard, right, without staking kind of the ability to attest to a validator and say that it's credible and it can actually accomplish the goal that it sets out to do to secure a chain, it doesn't really work. Otherwise, you're just going to have to trust like a random set of parties. So staking from individual people out in the market creates credibility for a bunch of different parties who can participate in the act of staking, securing the chains that we want to have our transactions on top of, which then gives us a place to be in the market. And the cool thing about this, really, that I think is the driving point behind the importance of staking, is that it's relative to everything else in the market, pretty low risk. Like, you need it for the infrastructure. So it's going to be around. There's going to be a pretty set inflation rate for a while, depending on which chain you're on, because you might have like inflation rate decrease as transaction fees increase. But overall, like it's going to be around. It's pretty low risk. You have a decent rate of return, and it's definitely higher than putting it in a bank. So that's kind of the layer that we inject ourselves in, is just providing that infrastructure to allow everything else that exists in the ecosystem to be there and provide value adds for everything that's going to be built on top of these chains.
Right, and without you guys and the infrastructure piece, like decentralization doesn't happen, right? So this is really critical.
Well, that's a really cool thing, right? So we can't be the only ones doing it.
Yeah.
And the whole value proposition of blockchain tech is that we're not the only ones doing it. So we benefit greatly from having really strong competition. I think there's a key term here, right? You don't want competition as adversaries. You want competition as collaborators. Everyone's working on this infrastructure collectively. So if you don't have a healthy field of competitors, like, you end up with centralizing forces. And hopefully, if a chain's built correctly, you're incentivizing a lot of very skilled validators to come into the field to help support the chains that you're building.
Yeah. Victor, you want to jump in?
Yeah, maybe I'll just, that was all fantastic. I'll just maybe build upon it a little bit in that staking has this really interesting component in that it's kind of trust upon trust. There's actually layers to the trust. And, what an infrastructure provider says that they do, like the security they provide, the trust that they garner with running infrastructure incredibly well is one thing. But from the outside perspective, you actually a lot of the time cannot prove that they're doing things the way that they said that they are, right? You have no idea a lot of the time how they're running their infrastructure unless for some reason they gave you access to go and audit them or do a pen test or whatever, which is rather rare. And so it's actually super fascinating because not only do you have to be an incredibly strong, secure, thoughtful provider and run the infrastructure incredibly well, but you also have to always engender trust with the community and with the way that you're doing things. And so when it comes to DeFi protocols have different standards, but with us, we like to be credibly neutral. We like to do well by the community. We like to participate in governance. We always want to be good actors at every part of the stack. And that becomes even more important when it comes to liquid staking and when it comes to institutional adoption, because one of the dangers with liquid staking, right, that's currently hypothetical, but maybe will be real at some point in the future, right, and Vitalik and other folks talk about this, is that when you have liquid staking, the person that's actually staking, the person who has the tokens, they can sell them or they can get rid of them in some way, shape, or form and not take ultimate responsibility for what happens at the chain. And so as you're building these layers of trust, right, and as you're encouraging institutions and enterprises and these masters of the financial universe to come and interact with these things, you essentially have to have these layers of trust be built upon one another. And if you build a lower layer not as well as you should, right, let's say you run infrastructure poorly, you'll break every other layer of trust above that. And so it gets really interesting. And the more that you spend time in the space, the more you understand a lot of these nuances.
And then I want to talk a little bit about what you guys are looking for in protocols. You can't stake on everything. There's just a lot out there. So, what attracts you to a protocol? What characteristics are you looking for in something where you're considering staking on it? Sure, if you want.
Yeah. Okay. I'll go quick. I think one of the most important things is that as infrastructure providers, we do not want to have control. We do not want to be able to, we don't want to censor. We don't want to, act in a way that requires us to take custody of tokens, for example. We want to be the most unopinionated infrastructure providers working in the background to keep these chains secure and decentralized. And so one of the core things that we look for is that, chains that are, much more heavily centralized or much more heavily, require node operators to, for example, take custody of tokens. Those are challenging things for us, because they open up avenues for attack, they open up avenues for regulation that wouldn't otherwise apply. And so we have this base case of, does a protocol match the right characteristics for us to be able to support it at scale over a long period of time? And then I'll pass it over to others.
Yeah, I know Parker has thoughts.
Yeah, so I'll quibble with you just a little bit there, right? So I think that there's something that, there's a new narrative that we're kind of seeing unfold a little bit that I think is going to be really intriguing to explore, which is what's good decentralization? Right? You can have decentralization on a chain, lots of different validators running on a chain, but that doesn't necessarily confer a hyper-secure protocol. It actually makes things really difficult to do. We're talking about the trilemma there, right? You have sufficient decentralization, scalability kind of gets a little bit difficult, especially if you have higher security. So trying to balance everything out so that you're in a place where you have sufficient decentralization is going to be a really interesting thing to watch. And so what I'm interested in when it comes to looking at the protocols that we support, and I mean, I'm seeing a lot of other people in the space also support this thesis, is like, are you being thoughtful about how you're going to decentralize? Are you being thoughtful about how you want validators to interact with you? Are you being thoughtful about how your infrastructure is built with a sufficient level of transparency that we as validator providers, as infrastructure providers, can also cover our bases as an operator? And so to us, like, a lot of the time, we have to take sort of an advisory role when it comes into like how chains are being built. Any infrastructure provider should be taking on this responsibility, right? So that's another layer that's really important, is that if you're talking to a protocol, are they being sufficiently thoughtful about how they're approaching their design? And it's surprising, like, there are a few that probably aren't. And you come into that conversation, they're like, oh, wow, we haven't really thought about that.
Anna, I want to bring you in. We haven't heard from you yet. Do you have any thoughts on, looking at different protocols and, what catches your eye, what gets you interested?
So I think I'm going to bring a little bit of a different perspective to this. So basically, we all know that L1s and chains are all very critical infrastructure, right? It's an operating system of the future. We have an economic policy and monetary policy built into that. And staking is really equivalent to government bonds. Why do we compare them to government bonds? Because they're low risk. Why they're low risk? So you trust government, right? United States government, even though the money is not backed by gold, but what is it backed by? Backed by taxes. What do we know? That death and taxes are inevitable, right? So it's always going to be there. Now, when you talk about chains, what is behind it, right? So we have fees, right? And those fees are here to stay. The chain is live. The fees are there. The validators will be collecting fees. Now, when you look at this, when you look into the future, basically, when you have economic policy built in, you have millions of users staking, you have billions and trillions of dollars in staking. So a question kind of comes up: well, who is to say that there's not going to be a new sovereign entity, right? So Elon Musk is building on Mars. Do you think we want to take our broken government systems there? Probably not. So maybe this is the future government system, but it may not be, it's not going to be typical government. Validators may be playing a very critical role. They may be today they're wardens, right? And they may be future politicians, political parties, unions, whatever you name it, right? So staking is how we get there.
Yeah, it kind of gives this whole new vision of governance and delegates and how's everybody voting and what are we going to change next. So
right, exactly.
Yeah, very interesting.
Exactly.
Yeah. That does bring me to, I want to ask a little bit about governance and how much you guys get involved, and I guess just the upkeep of trying to keep track of everything that's being proposed and how you're going to vote. How do you manage that?
So from our side, we try to stay somewhat out of governance. We let the protocol themselves and their community deal with that. We're there mostly to be a shepherd to the community. We focus on trying to set up. I think we're the only one on stage that has our own protocol and our own token. And so we're working on making ourselves a good community with our own DAO and setting up our own governance for our community and people in the ANKR community. And so that's its own challenge, right? Especially as an infrastructure company and for the future of Web3 and future of Web3 infrastructure. We've tried to take a hands-off approach to everyone else's community while we figure our stuff out.
That's fair. Parker, Victor, you guys have thoughts?
Yeah. So we have a whole governance team at Figment. We focus pretty heavily on governance. We're highly participatory, mostly in the Cosmos ecosystem because that's where we have the most impact and the most relationships. But it's pretty crucial for validators to have a place in governance, at least in a context building role. Voting is obviously crucial. There are times where large validator providers are the pivotal vote that actually allows a lot of proposals to go through, and so we have to be thoughtful about whether or not we're actually voting on the right things and putting in the right consideration, because it can seem very coercive sometimes in some of those environments. But I think it's really important for, at least on the validator level, us to be involved in governance in a strong advisory capacity, as well as participatory at the level of just being very, just being able to be a part of it. Because otherwise, a lot of this stuff doesn't move forward. A lot of different upgrades on chains don't move forward without governance going through. And it also gives us a level of visibility to make sure that the things that are going through and that are being added to the stack make sense in the first place. There's been a lot of things recently that we've had to engage with where we're oh yeah, that's being proposed to Cosmos Hub. Okay, well that part doesn't make sense. Okay, the initial vote was 100%, or not 100%, but like very high percentage yes, okay, it's going to flip in the opposite direction because enough nuance opened up on the market. And it's parties like us who actually are responsible for raising that, because we also have the level of expertise necessary to have the level of discernment and sufficient credible neutrality to be able to actually assess it from a direction that is, actually taking into consideration what it is we're contributing to and its longevity.
Yeah, Victor, I know you've compared this kind of to being like the watchtower. I think I heard, maybe it was your ETH Denver talk where you said you tend not to be a ton of fun at parties and weddings because you have to do so much research.
I don't remember saying that.
I found it. It's on YouTube. But just talk to me about just how much work goes into this and just trying to keep up with all these different proposals and figuring out how you're going to position yourself.
Yeah, I think that's such a great question. I think that the way that we look at our Coinbase Cloud is we're actually take a very binary approach, and the way that we decide whether or not we get involved is on whether or not it is a technical upgrade or a technical issue. I think there's so many social nuances and dynamics and so many egos sometimes. There's a lot going on, right? Especially when it comes to funding proposals, for example. And when we think about what is the number one way in which we can add value and what is the area that we have the most amount of expertise, a lot of that comes down to the technical side of things. And so the proposal, so we do one of two things essentially. The first thing that we do is with technical upgrades and proposals, those are the things that we vote on, have a perspective on. The more disputed it is, the more that we speak up about it. But the second thing that we do is we take a very intentional approach around proposing and passing governance proposals that we think make a strong technical difference on that protocol ecosystem. And so as an example, one of the things that we worked on is the first decentralized protocol merger, that was between Keep Network and NewsCypher. And that was one of those things where the technologies were super similar, the communities were super similar, and they were essentially going to build all the same things and compete with each other. And so you say okay, is this something that we would normally get involved in? No, but the technical component of it and the merging of the roadmaps and the merging of the strategies and the skill sets and the validator sets, well, node operator sets, made sense for us to do so. And so it's a little bit of a fine line, and because of that, we don't participate in a lot of the other governance proposals, but we do that with a lot of intention because we want to stick to the things that we know really well.
Yeah, that makes sense. So I want to talk to all of you. I guess, what do you think is next? We're in this bear market now. The people who are devs are going to be head down working on things, or so the saying goes. What do you want to see them come out and build that's going to, make your jobs easier, more interesting? What are you hoping to see on the other end of this market cycle?
I want the devs to do something.
But what?
We keep asking.
Make token go up.
We've invested heavily in the last 6 months in both our sidechain infrastructure and also our gaming infrastructure. That's where we see the biggest growth for whatever this bear market looks like. It's where we saw it coming anyways. And so we built out the sidechain infrastructure for BNB chain from scratch for them. We're also a key sidechain infrastructure partner for Polygon and for Avalanche for their subnets. So we just launched an app chain as a service thing. I think we're the first to market with that we can do on any of those chains. We see all these dApps that get created, whether they're games or large enterprises that want to come into the space, they're going to want some version of their own blockchains, their own validators, their own node networks on top of the other infrastructure. So that's where we've invested most of our, I'd say, our 2022, as well as helping game companies that are Web 2 games move into Web 3 with an SDK that plugs into Unity and Unreal, which also gives them their own validators and staking options. So that's where we're at for staking 2022.
I guess we can keep
I'm
going.
going to do a shameless plug. So we're building a decentralized fiat gateway. Okay, it's never been done before. It's a very interesting problem to solve because we have a fintech on one side and DeFi on the other side. So, and talking about governance, talking about DAOs and decentralization, it's going to be very interesting because I do believe at the end of the day we do need to bring more people in. It has to be cheaper, it has to be faster, it has to be more native, right? So
difficult. And so what I'm kind of hoping to see in the near future is that there's better partnerships with smaller validators who validate on a number more of these, not really maybe experimental, but less developed chains is maybe the better way of putting it, because that's a good niche to fill.
right? Like I'd love for us to be able to have all the bandwidth in the world and support every chain that exists. Love to get there. But the reality of the case is that when people are in that experimental phase, sometimes it makes sense to work with people who are willing to experiment.
Yeah, and maybe like re-raising, one of the points that you talked about yesterday. If you think about it, like as infrastructure providers, and I'll use Coinbase Cloud as an example, right? Like we've built an incredible amount of tooling so that when we add support for a particular chain, like that chain gets all the benefits of all the stuff that we built over the last 4 years, right? And so you have global blockchain sync that allows the nodes to come up super quickly. We have like double signing protection, high watermark software. We have like all this other stuff that took a long time to build, takes time to integrate. And so when when you get that support, you have, and not just us, but like across the board, you have this incredibly high standard for how well the infrastructure is run, but commensurately, you have higher costs, right? And so that's one of the challenges, like working with smaller protocols that are like more up and coming. It's that like, the level of service that we do is like over here, right? But they're not quite there. And so it's like, we can still add support, but then we're like making a bet that essentially like that, those needs are going to rise as well. And so it's fascinating because that evolution's kind of played out, and so there's still a lot of smaller kind of like chain-specific infrastructure providers. And so what a lot of us are working on now is like, how do you continue to add support for like all these new up-and-coming chains, which is continuing to accelerate, but still at this super high bar of service that all of us here strive to provide.
Okay. I do still want to come back to you. What do you want to see the devs build?
Okay, I'll be really quick.
Yeah, I mean we have a few minutes, so you don't need to give us too long about a lecture on it.
The first thing, I'll be a little bit of a self-shill in that I am super hyped to build Alluvial with Figment. Like, if you actually think about how enterprise adoption for tokens work and for AVAX and everything else, right? There's like level 1 of I'm just gonna trade like futures on some market, right? And AVAX like might not even have that. I don't know if anybody does, like predominantly Bitcoin and ETH, for example, right? So that's like level 1. Level 2 is I hold the asset. Level 3 is I stake the asset. Level 4 is I do things with the asset that are not just pure staking, right? And so like when you're talking about onboarding institutions, like each of those levels usually takes like months to years. And so when you have something that's like, hey, as soon as you come in, you have a liquid staking token that is like freely tradable and accessible on your balance sheet, and you can like trade it on exchanges, and you can put it into DeFi. It kind of like skips out on a lot of the onboarding steps. And so I'm super hyped for Alluvial and just like enterprise adoption of like liquid staking tokens, that they're then going to be faced with the challenge of like, okay, hey, this thing's like not locked up. It is liquid. You can do stuff. You can make more money. Go, get some guys on and go figure it out. And I think that's going to be really great. So I apologize for the self-shill, but I'm very hyped for it.
It's okay. I like to get some guys on it and figure it out. All right, and then I'm going to do a little bit of a lightning round. I'm stealing this from my editor-in-chief, who's up next. So really quick, without thinking about it, someone who's not on this stage, who's an up-and-comer that you're really interested in, you're watching. Anna, I'm going to start with you.
Up-and-comer that I'm interested in? I think it's the Fluence project. They're building decentralized cloud with their own infrastructure and new language. So that I definitely need it because AWS is costing me a fortune. So I'm really looking for better solutions.
Nice. I guess we can keep going down the line. Okay. What you got? Sui.
Really excited about Sui.
Sui was a good call.
Yeah, I'm just going to say that. Eddie, actually, like, Move as a programming language is maybe the up-and-comer I want to look at.
Okay.
Really curious there. So, but Sui, right off the bat.
Man, I've been playing with games lately and looking at them. So there's this one called Super Powered Squad, which is like the AAA games that are coming and bringing in Web3 components. I think are really interesting. I don't know which one's going to hit, but one of those is going to make it. And it's going to be really interesting for the industry.
I'm really excited for Aztec. It's a privacy layer 2 on Ethereum, and it allows for you to very cheaply and privately interact with like real DeFi on Ethereum mainnet, not fragmenting liquidity or anything like that. They just launched 2 weeks ago, so try them out.
Very cool. All right, I want to get, I don't know, do we have any questions? Are we doing questions? I don't think I see any. All right, I think we made it. Thank you so much, everybody.
Thank you.
Thank you.
Thank you, Stacey.
Thank you.
Thanks, everyone, for being here.
Can you just do like a check into the mic?
Check, 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 check. Nope. Hello. Check, check. Okay. Hello, hello. So one of the things that I love about bear markets is that obviously it separates the wheat from the chaff, and as you can hear from some of the comments in the previous panels, it seems like we're in a phase where people are really searching for more utility and real use cases on the blockchain. So that's, I guess, one of the good things. And speaking of which, we have a really great fireside chat, I guess you could call it, coming up here. I'd like to invite to the stage Daniel Roberts from Decrypt. Come on, let's give him a hand, guys. And he's going to be joined by our very own John Wu, president of Avalanche. Enjoy.
All right, everyone come back in. Go. All right, Daniel. All right, everyone file back in. It's John Wu. All right. Well, first of all, thank you, Avalanche, Avalabs. The bear market. You got to talk about what's going on with the bear market and how that affects things, especially because we're here to focus on the institutional aspect. We want to know what institutions are doing, especially as it
has been very negative. The institutions who are trying to apply the blockchain technology to either streamline or to do new tokenization of real-world assets, their interest has absolutely not waned. You know, anecdotally from my call volume when talking to people who are institutional and want to figure out ways to deploy things, you can even, don't take my word for it, look at the news. JP Morgan continues to do their JP Morgan coin. They are working with also the DBS, MAS, trying to create basically wholesale lending tokenization so they can start a DeFi project. Just most recently, SocGen and their partnership with MakerDAO, they're trying to collateralize things so that the DAI stablecoin can actually trade as well. So the actual movement of stuff for institutional purposes has only increased and not decreased.
When we talk about institutions, you know, a lot of people define that word differently. Sometimes it means publicly traded companies, sometimes it's hedge funds, family offices. As it relates to Avalanche, what are the institutions that are getting into the Avalanche ecosystem? Who are they, and what should excite them right now?
Yeah. So actually, it runs the gamut. So you have big, massive asset management firms looking to get into using blockchain and crypto to tokenize assets. You have the family offices who want to get in as from an investor perspective, but if you're going to do some tokenization, you need the buy side, and that's where the family offices get to come in. So it really goes up and down the spectrum. And just so some points of clarity, you know, we're talking about institutions, and then, you know, you started off with the bad parts of the market. So when we talk this conversation, when I say TradFi, that's what I mean by institutions like banks, large asset managers. When I say CeFi, I mean really the 2.5 guys, the enablers of getting onto the DeFi world, which is the third bucket. DeFi, which is really crypto native, self-custody type of situation.
Even the term TradFi to some in crypto is kind of a dirty word, right? And I've always been fascinated by, you know, I started writing about Bitcoin in 2011, and still to this day, there's an interesting tension between the true kind of degens, the people who were attracted to crypto because it's outside the banks, it's outside regulation, it's kind of over here. And now as crypto has gone more mainstream,
to talk about TradFi in this, especially if you started the conversation Now, it's amazing because the smart contract enable players, the dApps, basically, effectively, because these things are in bankruptcy now, those guys, which is basically, I guess, counts. So if Celsius uses an Aave is kind of a business partner, if you can proxy that for like accounts payable. In the traditional world, they will be not even in the discussion for getting paid back. You have customers, and then you have the senior secure, and then go all the way down the stack. But because smart contracts were enabled by code, and the code replaced lawyers and replaced the enforcement, all of a sudden, those people got money first. So effectively, they literally subordinated even the secure lenders.
So the system has worked?
That's what the system's supposed to do. So it's worked, it's painful, but it actually worked.
Except maybe for a certain notorious algorithmic stablecoin.
Okay, so it was not 100% non-DeFi, but even with Terra Luna, if you were, so their biggest fault was they actually, well, not a bit, there was a lot of issues, okay, let's just be clear. But when they tried to create a reserve basket in order to have a stronger tether to their stablecoin, that actually is very simple to an emerging market central bank tethering to like the US dollar or a basket of currency. So what they got wrong was a lot of native crypto people actually do not know finance. So in 07, 08, there were things called CPPIs, which is Barclays used to do this. Basically, what they did was they created a basket. So like when hedge funds wanted to go and use collateral to lever up, they separated different tranches for volatile and stable assets to separate the thing. And then they had a trigger, basically, if the volatile asset continued to go up, you push the threshold higher so that the collateral moves with the value of the stuff going on. Doe just went with a bunch of very volatile stuff. There was no stable part in that basket. So I would argue that if he had more maybe finance experience, maybe he would have created a different reserve and would have been more productive.
Algorithmic stablecoins can work, it sounds like.
Well, it kind of becomes non-algorithmic when you...
Yeah. I want to make sure, we're talking about institutions.
You saw that with Maker too, right? And then they started creating reserves.
Right. I want to make sure that we hit on some things that will interest everyone here in the room. I'm seeing a lot of people who are at this event, and a lot of the buzz around Avalanche is about this too, gaming. What is exciting and what is going on right now with gaming and Avalanche, and is that something that institutions are excited about? And the reason I ask that is just to push on, for a while, the most prominent example of crypto gaming was Axie Infinity. And that had some real problems, I think, that came about, whether it's gameplay or whether it's having to buy the 3 characters to get into the game. Now they've adjusted and maybe it's on its way back, but you hear about a lot of blockchain-based gaming projects that are saying, well, maybe play to earn isn't the way to do it. So what's happening with regards to gaming and Avalanche?
So we're taking institutional definitions to other genres now. So we'll separate between incumbents versus crypto native. So when you say gaming companies, then I'm interpreting that as AAA publishers that make great, unbelievable games, PS, whatever, 1000, and Microsoft, Xbox, whatever, and Nintendo, X, whatever. Those are people who are making those types of games. And then you have crypto native, which is a lot of the play to earn stuff. For what is very exciting here from a top-down perspective is that all of these AAA publishers are calling us and calling, I'm sure, other blockchains as well, and trying to figure out how they can incorporate the blockchain experience into their overall experience of gameplay. The reality is, right now, the gameplay is just like NFTs. It's not going to be on the blockchain. It's the right of ownership of whatever asset associated with the game or transaction that is on the blockchain. So the game is just like an NFT, stored in a centralized server somewhere else. From a micro level, what I think is most exciting right now, and you mentioned Axie Infinity, is that the Avalanche Subnets, which is basically a subnetwork of validators that you can have. You can almost think of it as blockchain as a service. And a lot of game companies now are adopting the subnet because we're basically giving them an SDK for them to go out there and create and do what they know best, which is the game, and then also acquire customers. With Axie Infinity, we've seen issues because they had to create the substrate from the very ground up. Let the people who create the substrate create the substrate. We can hand you over this blockchain as a service SDK. You just focus on what you do best, which is gaming. So that's, I think, from a micro perspective, the most exciting thing.
Yeah, it's interesting, and I'm glad you mentioned the subnets. I was going to ask about that, but I guess we've hit on it. That seems to be really buzzy, and it's all about kind of what's being built right now. And for a lot of other blockchains, and we haven't even mentioned Ethereum, we haven't mentioned Solana, but a lot of the buzz and a lot of the chatter is still kind of what's to come. And also, I'm used to hearing that when it's a crypto winter, everyone says, well, we're heads down and building, and there's all these great things that are going to come. If I were to push you on what's already happening on Avalanche, or already a kind of killer use case we're seeing, what's exciting?
Killer use case for what?
Right now, yeah.
For anything.
Or for AVAX.
Well, okay, so there's a lot of exciting things going on, and the reality is no one really knows what the killer use case will be. I think in hindsight, maybe people may say, just like with email was the killer app for the internet, maybe the stable coins at some point, reserve ones, maybe USDC, because they're they make things liquid. But what is super exciting on Avalanche going on right now, we talked about gaming on subnets, but there are also institutions who are creating, tokenizing what we call real world assets, RWA, onto the Avalanche blockchain. I'm looking around because there's a gentleman here who's CEO, Sridhar. You can raise your hand. He's all in the back. I think he's not here. But Intane, which basically is they're very industry experts on how to do this. And if you think about where blockchains are most effective, they are most effective when you need simultaneous movement of information and payment. And it's amongst many, many participants. You need to decide on both sides and then match them up and then have an instant transaction. That's where blockchains could be extremely, extremely effective. So Intane's a company that's been around for 4 years. Great CEO, I just met him and had a long conversation with him. We are funding the company, and they are deploying a private blockchain on basically a permission of authority blockchain using a subnet. What they've done is they've exactly done what I just said. They've separated the administrative side versus the tokenization of an asset or the issuer side. And when you think about a structured product, there are literally, it's not just the issuer to the hedge fund that buys the structured product. There are so many people in between, 6, 7 different participants, and it's a very inefficient process. Middleman, intermediaries, whatever you want to call it. What they've done is, using a blockchain, they are able to have, one true source. So it makes everything much more efficient and then saves money on the administrative side. The next thing they will be doing will be taking that and creating, because it becomes so much cheaper, right now to do a structured product, it takes literally, if it's not a $100 million deal, there's a lot of fixed costs, it's not affordable. So they are going to be able to allow 10 to 20, 30, $50 million deals in structured products and pool assets that way because they're going to make it affordable. So I'm very excited about that as well.
Just a quick interlude. I want to allow time for a couple questions. So if you guys have any potential questions for the John Woo, prepare those. Let's talk a little bit about, I don't want to say the competition. And as John knows, this is just a great answer we got from him a few months ago on our GM podcast. So quick plug. John was a guest on our GM podcast at Decrypt, and I asked about this. But for a while, and I hear it less lately, maybe that's a sign of success, but Avalanche was grouped into these blockchains that are sometimes called Ethereum killers. You've heard Solana called Ethereum killer. And I asked John about that, and I think he said, well, we don't view ourselves as a competitor of Ethereum, or we don't view Ethereum as a competitor. Has your thinking evolved at all when you look at the landscape out there? I mean, especially with the merge supposedly coming. It's been delayed quite a few times. People think that's going to be very exciting for Ethereum. There's a little bit of a sense that it's still the kind of crown jewel when we talk about everything other than Bitcoin.
I think what I said on your podcast was the space is so small. It's really, I can't believe people are so tribal in the space because there's millions of 30 million web developers out there. There's like less than 100,000 blockchain developers out there, and we're all trying to fight for how many of these developers. It's like ridiculous. We should all be working to get more access to the 30, 40 million developers on the web. iOS has 3 million developers. Android has 7 to 10 million, I forget what number, but there's just such a bigger world out there, so it's no point in actually attacking each other. We don't think of ourselves as Ethereum killer, and we want them to be successful because they bring in a lot more people into the space, and that's what we need. I mean, I know there are numbers being thrown around, like there's 150, 200 million people in blockchain. I call BS on that. I mean, there's 150 million people who are on Binance, Coinbase, and FTX that are off-chain and that speculate on crypto. But I think you take that and you divide that number by 10 or 15, and there's really only like 10 million people that are actually in protocols using a MetaMask or really doing DeFi or buying NFT and self-custodying the way decentralization was meant to be, where you profit and own your own data and your own stuff. So there's really not that many. If there's only 10 million people that are actually really using blockchain, not speculating on it, then we are literally, I think Amazon in 1999 was like less than 10 million people. You know, I think Amazon, I remember this distinctly, in 99 was like 7 million users. And then you go into the, you know, big sell-off. Amazon stock actually almost went to zero. They had to take out bonds and converts to actually stay afloat. And then when the bear market ended in 2003, they had 40 million users. So we're at 10. We're basically Amazon 1999, in my opinion.
I say that all the time, that the money may be big, but the actual number of individual users is still so small. We're still so early.
The space has far more news and marketing relative ratio to actual utility.
Quick lightning round for you, John. And I did not.
It's been a lightning round.
I did not warn John about this. This is even more lightning round, but John can handle it. Real quick, just 1 or 2 sentences, answers to these prompts, and then we're going to have 2 questions from the audience, if you guys have any. So real quick, reflex answer: Bitcoin maximalism.
Why?
Applause. Bored Ape Yacht Club.
Building a brand.
NFTs triggering gamers.
It's happening.
What?
It's happening.
Binance and CZ.
Look over your shoulder for Sam.
Very good. And I'll end on Gary Gensler.
Lee, where's my general counsel?
Really good stuff. Are there 2 quick questions from the audience for John? Let's go right here.
Hold on. Hi. How do you catalyze the adoption of DeFi by TradFi amongst TradFi companies?
How do you so the question was, how do you catalyze GameFi? Catalyze DeFi.
Adoption by TradFi.
Okay, so I think that is a big theme. I think when you come out of this winter and we see spring, there are enough real-world assets that's going to come over, and the dollar amount we're talking about real-world assets are just far more than what we have in DeFi. In order for that to happen, I think there are 2, maybe 3 things that you absolutely have to have. You have to have, I think, one thing I think you have to have is a proper identity. So for TradFi to really come over and adopt things in DeFi, you really need KYC, AML accreditation. So there are firms out there working on good identity mechanisms so that people can be compliant. That's super important. You don't have that, TradFi will not adopt this not very well. The second thing is, I think crypto people have to get these absurd 20%, 30%, 40% yields out of their mind. If you look at all these, crazy yields that you're getting, only 1/3 of them came from true market forces of supply and demand imbalances from loans, lenders and borrowers, because there's a nice natural spread. The other 2/3 usually came from incentives, which relied on the faith of some governance token or something to be worth more tomorrow than today. And frankly, there were a lot of 2.5 companies that use the capital markets to continue to fund their growth of customers or provide more yield. So once the crypto people realize that, hey, you can enhance yield by having the efficiencies we talked about earlier, but but not these crazy 20% yields, you'll have more adoption from the crypto native as well. I think, and the third thing I would say is, I think we need some understanding that not all stablecoins are like Terra Luna. USDC, it's well known and proper auditing and very transparent what's underneath there. And if there is more adoption of stablecoins, which is the gas that makes blockchains go, then that would be the third thing that is necessary.
One more question.
So my question is mostly about the ethos of the space and some of the changes. Avalanche has really taken the world by storm with both TVLs, pools, lending, centralized, stablecoins, things like that. I'm really curious what you think about consumer behaviors, and if you think there will be changes in consumer behaviors, or you think crypto will be mostly used for back-end infrastructure, for banks, financial providers, and other groups.
Whenever I hear someone ask a question with "so," it's usually a very skeptic in this space. But with that said, how does consumer behavior, how will consumer behavior be affected in the future when there's all these institutions that come on and use basically DeFi? Is that the question? So, I mean, I think people are already understanding some of the best benefits and being a consumer in the space is the fact that you have two choices. You can basically have your own, you can own your own assets and you can, profit from it, or you can give your identity up, so to speak, and create and have efficiencies. So there are companies in the space like Brave. Brave has their own browser and they have, the Brave search engine. So they actually, when you go onto Brave, they do not allow the tracking of your searching and your digital fingerprint. They prevent that. However, they let you opt in to monetization. So if you wanted to opt into monetization, you'll get paid directly. You make the decision that you want to sell your privacy, and then you get paid directly for it from the advertisers. You get paid for it in the form of a Brave Attention token. But I think consumers will also continue to realize the power of owning your own data. Right now, basically, places like Facebook and 7 people in California and 1 in Seattle basically have hijacked and usurped all your digital identity as well as your privacy. And even though you know it, you have no other options, so you continue to use it.
Love it. Quick round of applause for John Wu.
Okay, thanks very much, guys. We're going to take a 10-minute break, so this is your chance to get that slider I was talking about. I would recommend the ice cream, and the pizza is also great, not to mention the hard seltzers. Have fun out there. And the simulators. Try your hands at the simulator.
Hello, everybody. My name is Robbie, and for our next panel, we have something really exciting for builders. So if you have any builder friends out there, go snatch them, because we have Anthony Campolo here who's going to take us through how to create a dApp on Avalanche with QuickNode. And it's super cool and super easy, so enjoy. Thank you.
Hello, everyone. My name is Anthony Campolo. I'm a developer advocate at QuickNode, and I am connected. I'm not sure what I need to do to... Oh, there we go. Look at them pros over there. All right, so we are going to show how to deploy a very, very simple smart contract. So if you all are like, I don't code at all, I'm going to have no idea what's going on here. Trust me, you might figure out more than you think, because there's going to be just a couple little things going on here. We're going to have a contract that's going to write a message to the blockchain. We're going to read that message back. That's all we're going to do. It's called a Hello World application. And the way we're going to do it is we're going to grab an RPC endpoint from QuickNode. We just recently started a free tier as well, so if anyone wants to spin this up, you could do it right now. You don't even need a credit card. Now, we're using Hardhat, so it's a very common development environment if you've ever done this kind of stuff before. And you just have to specify what network we're using here. And so if you know, Avalanche has the test network being Fuji. So we're going to deploy a smart contract to Fuji. And all we need is our QuickNode URL, which we get from over here, and then a private key from your wallet, whichever kind of wallet you use. And the only other thing you need is to put this part at the end, because we are using the C chain specifically. Because one of the cool things about Avalanche is it's compatible with Ethereum, EVM. So if you write something and you want to deploy a smart contract to Ethereum, you could deploy basically that exact same smart contract to Avalanche. Here is our beautiful contract. It is a Hello World contract that just has a single variable, hello message. And when we initialize the contract, we will pass in a message that will set it to our hello message. And then we have a single function that just returns that message. So that's all that's going on here. And then when we actually deploy it, we see that we're going to pass in this message, which is going to be hello from Avalanche House. So once you got your endpoint and your private key in there, everything else is good to go. And you're going to run yarn hardhat compile. That's going to compile your smart contracts ABI. Don't worry about what that means. And then we're going to actually deploy it. Hardhat run scripts deploy, and then you can specify the network here. So we're specifying the Fuji network. Not sure how well you can see that, but the main important thing is it gives you this smart contract address right here. And then we're going to put that in our little React application over here. All this is doing is it's writing some JavaScript to basically hit that contract and then run that hello world function that we originally created that is going to read back that message. And then it will display it on screen for us when we click this button. So now we kick this open on localhost 3000. You see here. And then hello from Avalanche House. And then if we check our console log, we can also see we're getting back some more information as well. And then this is our wallet, which is now connected. And then since this is just a React front end, it is very simple if you want to deploy it to just run a command like Vercel, and then it will take this whole project and then shove it up online for you, and then that's your dApp. So once that is finished, we will have a live dApp. Any questions? Yeah? Okay, so then here is our actual link here. Boom, boom. So this is on a live endpoint right now. So it's going to ask us to actually connect. So we're going to connect, and then there we go. Hello from Avalanche House. So there you go. If you go to avalanche-house.vercel.app, you can connect your wallet and read this beautiful message yourself. All right, cool. Hopefully that made sense. And if you want to check us out at quicknode.com, we have a bunch of chains, but obviously you guys are all here for Avalanche, so you can check out our Avalanche offering. This is one of our newer chains, actually. This is just added in a couple months ago, and I've been working on creating guides and doing live streams and just building out a lot of content around it, which is where projects like this came from. So if you're someone who wants to learn more about how this stuff works, we have a lot of great guides for you, and then we try and make it as easy as possible to just spin up and work with Avalanche. All right, thank you.
Hello, great job. Thank you very much. Is everyone sure we don't have any questions? Just making sure. You do? Okay, good. I thought somebody would have a question. Okay. I'll give you a mic.
Yeah, perfect. I don't want to yell. Hi, I'm Dennis. My question is, we deploy subnets, right? So are you guys hosting validators that run on subnets too, or are these for like the C chain nodes?
This is for the C chain specifically. So we give you a full endpoint, and then you can kind of decide what you want to do with it. So we give you the endpoint, and then you add in the actual like C chain part here as well. So if you want to hit any of the subnets, you can do that.
Okay, cool. Thank you.
Yeah. Nice. Yeah, and you can check out our docs here if you want to see the Avalanche specific kind of methods. So you got them all here. So you see you have like the AVM ones and the ETH ones. And we got swag too, if you want swag.
Lots of swag too. Okay, well thank you very much. And just a reminder, this is live stream, so you guys will be able to review this too later. So really
and there's
appreciate
a guide if you want to check out this guide here. It'll do that, but a lot slower and with more explanation.
Well, let's hear it for this gentleman here. Thank you very much. We're going to take a 10-minute break. Make sure you come on back for some more good panels. Hello, ladies and gentlemen. It is my pleasure to introduce to you the one, the only, John Nahas.
Thanks, Robbie. Hey, everybody. As Robbie said, my name is John Nahas, Vice President of Business Development at Ava Labs, supporting Avalanche. We're going to talk to you today about the Web3 world according to Avalanche. What is a Web3 world, right? We hear this term Web3 all the time. The Web3 world to Avalanche is practical, it's achievable, and with some focus and determination by the people at Ava Labs and this amazing community and good execution, something that we can definitely achieve. And the thing that we're trying to achieve is a global, decentralized digital economy. That, at the core, is what Web3 is. It's a place where anybody, a developer, a business, a creator, a company, or an artist can create a new economy that's both digital and interconnected, that's linked by technology across the world, allowing everybody to break barriers and unlock potential globally. But real quick, let's take a step back and look at where Web3 is today. First of all, there's entry barriers. It's hard. It's elitist. Let's be frank. John Woo was talking about this earlier. There's a bunch of people in this space that are speculators. But in truth, the number of active users isn't really that high. It's because the barrier to entries are hard. There's an education gap, and people in our space are somewhat elitist. We like to talk about seed phrases and wallets and acronyms that most people, like our friends and family, have no idea about what we're talking about. There is a little bit of elitism there. We need to bring that down. Secondly, it's unreliable. Gas spikes, hiccups, downtime, a million things that happen and go wrong that the media loves to, of course, harp on, don't help. And finally, it's siloed. Different use cases exist on different chains. A niche is good to specialize in. But if these things that we are building are not interconnected, that don't make life easier, we're not helping ourselves. Something that was discussed at the Avalanche Summit, I was on a panel with the head of innovation of MasterCard, and he made a really good observation. People like to wonder where we are. We're still really early. But we're not at any kind of an end, but we are at the end of the beginning. So we're just about to start taking off to where Web3 can really succeed. So talking about that, what do we need to win, right? What does Web3 need to grow, to become ubiquitous, to rival the things that exist currently in Web 2? We have 3 pillars of focus here. First, wallets. Wallets, practically speaking, are users. They're people, right? Every one of you has a wallet or is a wallet, and the way you interact with that digital world is your entry into Web3. Second, assets. We have to digitize all of them. There's billions, if not trillions of dollars of what John Woo said, real-world assets sitting on the sidelines that are either analog, physical, or like what most of us deal with on a daily basis with our banks or TradFi, electronic, but they're not digital. We need to digitize everything and break down the barriers, make it interconnectable. Finally, applications. Those are the ways where wallets and assets can interact. So, the journey to Web3. If you're familiar with Ava Labs, this chart might make sense to you because this is the way that the BD team at Ava Labs is broken down into these 6 verticals. First, institutional and capital markets. These are the incumbents. This is TradFi, right? We need to remove those intermediaries or those rent seekers from the equation and allow people to transact one-on-one. Second, enterprise. Enterprise is existing businesses. These are your Amazons and your stores and everything that you transact with on a daily basis. We need to make it faster, we need to make it easier, and we need to make it inexpensive to transact in Web3 through enterprises. Now we begin to talk about the entry point into Web3, which is exchanges and wallets, right? These are the entry points, simply put. 4, GameFi. This is a new and growing vertical that will onboard tens of millions of users. Let's be honest, gaming is a huge way for massive amounts of people to enter Web3. Whether knowingly or unknowingly, with it in the background, GameFi has the ability to bring people in with play to earn and a million different innovations that are happening. Next, NFTs, a wide-ranging asset class, certificates of authenticity, whether it's art, ticketing, a million other things. Innovation is constantly happening. And then finally, DeFi, decentralized finance, the future of what we hope to be finance. Benefit of Avalanche, we cover all of these, from the most incumbent to the most disruptive and decentralized. Our goal is to take this side of the equation and move it to that side. And we've been focusing on that with some success. So how do we get there, though? Where do we see that future, right? We see the future with millions of billions of people benefiting from this ecosystem. So the crypto complexities that we are all so used to as Web3 or crypto native people, abstract it away. We have to remove it. We have to drop that elitism. We have to drop that idea that we have to teach people how to use these things, right? Fade it into the background. Just like most of us on a daily basis use SEPA and SWIFT and Fedwire to transfer money, or AWS and Azure behind the scenes of a lot of enterprises, we need to push blockchain into the back and let people just interact. So we see Avalanche powering global adoption in a future that is faster. It can't be slower than what currently exists, period. You can't wait for transactions to finalize. You need a digital economy that's at the speed of a digital economy. Avalanche finalizes transactions in less than a second. It must be inexpensive. You can't disintermediate the existing order and intermediaries by charging as much, if not more, in fees. It needs to be cheaper. It needs to make financial sense to ditch the existing world that people know and trust for something new that's uncertain still for many. Avalanche is as inexpensive as possible without sacrificing security and uptime. If you notice, I said inexpensive. I did not say cheap. We see what happens when people are cheap or cheaper. They don't always work. The future must be usable. It has to be easier than what people do now, period. No one's going to use it, and no one will care because you have to do a million steps to transact in Web3 because it's something special. We need intuitive flows and UI and UX that highlights the speed and the strength. And the future is decentralized. If it's not decentralized, it's simply not worth it. Databases do the job already. Enterprises already exist without blockchain technology. It needs to be distributed. It needs no controlling party or an entity that tells you what you can and cannot do. Obviously, there needs to be regulation, and there needs to be smart regulation. But as we've seen with some of these CeFi players in the space right now, they're controlling the situation. DeFi has stood the test of time, has worked during this market volatility. CeFi has not. Avalanche is highly decentralized, and it's resilient to attack. As stated today by the gentleman from Figment, Avalanche has the highest Nakamoto coefficient, the true test of decentralization after Bitcoin and Ethereum. Once Ethereum goes to proof of stake, we might be the second. Truly decentralized, and it matters. We can scale to millions of validators. We're currently over 1,400. And finally, and this is an important one, the future must be sustainable. The future of technology cannot be emitting as much as brick and mortar banks and buildings and everything that currently exists. For a future technology, we need to use less energy and be more green. Avalanche, as cited by the Cryptocarbons Ratings Institute, right? This is the team out of MIT and Technical Institute of Munich, did a study. Bitcoin, we all know, boils the ocean, 8.5 million US households worth of carbon. Ethereum, 1.6 million. Avalanche, the entirety, 1,500 validators, millions of transactions, billions of dollars transacted, utilizes the equivalent of 46 US households. That's it. Per dollar transacted, Avalanche is the most green blockchain. There's no promises here. It's in the fact, and the data shows it. So, that's what we see Web3 needing to succeed and where we have a place at the table. We have all the ingredients to enable that future. But how is Avalanche braiding all of this together, right? How is it making a better Web3 experience? We see Avalanche bolstering adoption through subnets. That's the first leg. Custom, app-specific blockchains, right? They empower builders to give users the best experience possible. If you're a game developer, your focus is to build a game. You're not a distributed systems engineer. You are not a blockchain engineer. We've seen what happens when games try and do this. It doesn't work. Our job is to provide the technology and the infrastructure to allow the builders to succeed. Specific applications need their own chains. Think of subnets as app-specific chains or business-specific chains, where you could create your own rule sets to fill in what you need to succeed as a builder, right? You need KYC AML, you can do that. You need geofencing, you can do that. Whatever it is you need, we give you the tools to build that. DFK, DeFi Kingdoms and Swimmer Network recently have gone live with dozens more coming by the end of the year, and we're really excited for the growth there. Next, of course, we can build the best technology in the world, but without people like you, without partners and applications, it's useless. We have 450 native applications live on Avalanche, not including the blue chips that have come over from Ethereum, such as Aave and Curve and Sushi and so many others. So we're proud of the community that's been building on Avalanche now for almost 2 years. Total native dApps over 1,000. And these are dApps that are working, that people are using, that are succeeding in Web3. We need multiple assets, right? Stable coins, NFTs, USDC, USDT, everything, security tokens, all kinds of new financial instruments that are being built currently on Avalanche. And finally, we do need support from the institutions. As you may have heard, Alpha Labs is a strategic alliance partner with Deloitte. And Deloitte has built a US government program using Avalanche, and they're continuing to do so as well. Lemonade is an insurtech provider building an insurance product on Avalanche for parametric insurance. So think about this. We're used to dealing with insurance companies. You have a claim, you have to go, you have to file, you have to do a million things. By using smart contracts and using the blockchain, and Lemonade, one of the most innovative insurtech companies using Avalanche to do parametric insurance. And we're starting this by targeting the most deserving, the most needy, those in the emerging world and farmers who can't get access to insurance on their own, or either can't afford it, by doing parametric insurance. Pay $5 a month or maybe a year for an insurance policy through an NGO that supports you. If you have a crop and the temperature drops below freezing, you don't file a claim. Smart contract pays you out right away. Again, eliminating middlemen, eliminating bureaucracy, eliminating red tape, and all the costs that we as users on a daily basis have to pay enterprises and partners to do the jobs that they do. Code it, automate it, make it easier. Oh, I already did that. I switched apps and partners with applications. So products, we need great products. Really proud of the work that Ava Labs has done building some great products. Some of you have been lucky enough to use the Avalanche Bridge. It's transacted over $50 billion of value since going live. $50 billion. That's only with Ethereum. Since Summit, we announced, and as of a few weeks ago, the Bitcoin Bridge. The first asset that brought all of us together and created this new economy. Bitcoin can either be lent on a centralized exchange or something else. True non-custodial Bitcoin is now available on Avalanche in DeFi thanks to the bridge. So we said subnets, we said the bridge. Finally, the core wallet. Ava Labs has just unveiled the core wallet. We encourage you all to test it and try it. And the excitement behind core and the amazing job that our product team has done is truly build an application or a product that works at the speed of Avalanche, that finalizes transactions as fast as Avalanche does, that has the ability to build in subnets. Think of it as a command center to really take advantage of all the benefits that Avalanche truly has to offer. So we've talked about the partnerships and we've talked about everything, but at the end of the day, I want to thank all of you for being here. I want to thank all of you for being part of this amazing community. We are truly at the end of the beginning and we're just getting started, so come build with us and come partner with us. Thank you, everyone.
Thank you very much, John. That was awesome. Okay, so next, everybody, we have macroeconomics. What should Web3 investors know about today? I'd like to welcome our guests up now. We have Casey Wagner, who's our moderator, Roshan from Genesis, Lucas from Jump, Aisha from Ledger Prime, and Tom from Masari. Give it a round of applause, everybody, please. Thank you.
I can scoot a little closer. Hi, everyone. My name is Casey Wagner. I'm a reporter at Blockworks. I'm really excited that everyone stuck around. I know we're cutting into happy hour, but excited to talk about macroeconomics. I'd love to start with an introduction. Aisha, did you want to start?
Sure. Hi, everyone. I work at Ledger Prime. We're a multi-strat hedge fund. And aside from Ledger Prime, I also teach blockchain at NYU Tandon.
Hey, guys. I'm Ro. That's a little stale. My last day at Genesis was in March. So I used to work at Genesis for 4 years running their lending book. And more recently, I'm starting a new hedge fund with a couple partners we're launching soon.
Hey guys, I'm Tom Dunleavy with Masari. Before that, I was with an investment consulting firm and then investment management with State Street Global Advisors.
Great. Okay, so I'd love to kind of start with a broad overview of the current macro environment. Obviously, we're seeing some pretty hot inflation. It's kind of a weird time with the dollar up and crypto down. I think that that creates an interesting environment for stablecoins, especially. So I'm interested to talk about that. But just more generally speaking, how are you thinking about the current macro environment and what are you watching?
So I think we'll probably see stagflation, but I would let others talk about it. But from crypto perspective and from the investing perspective, we have seen a lot of capital leave on the LP level because their LPs have either lost money in the equities market or just too spooked by the current crypto environment. So because of that reason, I think in past few weeks or so, we've seen the dust completely settling. The prices are semi-stable. And the market has started pricing in inflation rates and whatnot. So far, even though there's been a strong correlation, but we've seen so much of DeFi stocks, be it ETC, Avalanche, for instance, perform well. So I think crypto has overall been doing well for where the global macro could head.
Yeah, I mean, the macro situation right now is not really fun. It's kind of terrible, but like Aisha was saying, I think, as far as how crypto has performed, it's kind of in line with, what you'd expect as a higher beta to NASDAQ type asset. Things I'm looking for really now, what's interesting, rather than looking at the past, is kind of thinking about how things could turn from here. So watching really just energy prices really closely, Fed signaling. I think the July meeting will be super important. And in terms of long-term levels for crypto, where you're at right now on Ethereum, Avalanche, really just generally any of the layer ones, I think you're entering really good long-term attractive prices. So it's pretty comfortable to start buying spot, in my opinion. Oh, and I have to add, none of this is financial advice. Yeah, sorry.
Has that ever protected anybody? I'm never sure.
I don't know.
I put it on my put in your tweets. So. Yeah, so I'm just really watching inflation, and I try to dig into the components of it, because that's really all the Fed cares about right now, is when and if inflation will slow. So inflation has actually continued to accelerate, and that's not only in goods, that's in services, that's in the headline things we see like energy and food prices that the Fed can't control, but also the underlying things the Fed can control, things that are affected by interest rates, so housing being the primary component. So housing's 40% of headline inflation, 30% of the inflation metric the Fed looks at. So what they really need to do is bring down the housing sector and maybe not crater it, but bring it down to a level that prices stop accelerating. You have prices accelerating 20% year over year, and you're looking at those numbers come in month after month after month. And the way those calculations actually go into CPI, it's with a lag. So all the price increases we saw earlier this year, they're going to be reflected in CPI in later Q3 into Q4. So you have 6 to 12 months of lag from all the price appreciation we saw throughout the year. So just from the housing component of inflation, we're going to have something like 4 or 5% baseline before you even get to that energy and airline tickets and all the other things that are contributing to inflation. So the Fed needs to continue tightening, if nothing else, just to slow down the housing sector. And you can already see it if you look at sort of the housing data. It's starting to happen already. So that's really what I'm watching more than anything else.
Yeah, I like that you bring up the Fed. Obviously, that's a core topic when we're thinking about macro. I mean, in terms of what you're expecting for later this month, in June, obviously, we saw a 75 basis point rate hike. Are you expecting the same? Are you expecting higher than that? How could that impact crypto and equities more broadly? Tom, did you want to start?
Yeah, so I think the Fed is just looking for air cover to go 100 basis points. The Fed's all about expectations. So if the market, this happened last month, they saw, there was whispers about 75 basis points, and then all of a sudden it was in the public, sort of the mainstream, and then they could hike 75 basis points. We're getting whispers about 100 basis points. They have sort of all the Fed governors go out and do talking circuits about it, and then see sort of how the market reacts to it. And once that could happen, and once the market function, and the market reaction isn't adverse, they say, okay, I think we can hike 100 basis points. It's okay. And looking at all of the things that the Fed really cares about, obviously they care about employment. There are 2 jobs for every person looking for a job right now. Wages are still rising 4 to 5%. In real terms, after inflation, you're still losing money, but they're still very, very strong on an absolute basis. All of those things the Fed's looking at right now. Retail sales today, also strong. So all those things the Fed's looking at says the market's still strong, we have plenty of air cover to hike, so let's hike as much as we can.
I think it'll be 75 for what it's worth, not 100.
75, but I think that crypto has already priced that in. Yeah. So we're probably on a slight upward trend, but I think crypto is going to be stable again. No investment advice. I'm not saying go buy ETH or AVAX, but I think the crypto market has already priced that in.
Yeah, and Tom, I like that you bring up that the Fed certainly does not like to surprise markets. I always think that that's a good thing to keep in mind. And speaking about crypto, what could happen, inflation, I'd love to ask all of you kind of about the current correlation that we're seeing between crypto and equities. I think in May it peaked. Bitcoin and the S&P and Bitcoin and the NASDAQ were as closely correlated as they've ever been. It's fallen off a little bit, but how does that kind of play into that historical investment thesis of Bitcoin as an inflation hedge, Bitcoin as an uncorrelated asset? And how are you thinking about crypto just in regards to the broader market?
Yeah, sure. So I kind of think about crypto tokens in some senses as like a tree. So at the trunk you have your major layer ones, Bitcoin, Ethereum, Avalanche would kind of fit into that trunk. And then you have branches that are specific applications on them, like categories, whether it's AMMs or borrowing lending protocols, options protocols. And then usually those applications have their own specific tokens, which are kind of like the leaves. So when you see a broad market sell-off and all correlations start to elevate, I think your focus has to reshift a little bit to the trunk of the tree, because that's where kind of the beta will be. And you'll be fine to get broad exposure by focusing on that trunk, and realistically the leaves will probably perform poorly, or people will just generally care about them less when everything is behaving in sync. On the flip side, when you're in a later stage bull run and correlations are lower and there's more divergence amongst assets, I think that's the time to start focusing more on the application tokens and specific AMM or DEX tokens and things like that. So right now I think it's like, if you're going to think about buying a sushi or a uni versus just Ethereum, I think a better expression of getting the exposure is focusing on the trunk, and there'll be a time for it to shift. And you'll have to look at the cyclicality of the overall crypto market and the cross correlations to break down a little bit to start to see that shift. I don't think we're there yet.
So one thing that I would say is that with time, in months to come, we'll probably see less correlation. The reason I say that is because, yes, Bitcoin is used to be a great inflation hedge, but some of the other projects have been outperforming it from investment purposes, right? So yes, I think it wasn't even in May, but we had started seeing investor fears, I think around like February, March, you know, the Ukraine-Russia situation, and that's when we started, you know, market capital just getting sidelined. So what does that mean, you know, for, you know, people like us that are managing it for others? We're, instead of, you know, our bets are being, you know, on BTC or ETH as a whole, we're basically counting on smaller cap tokens because we have seen they're outperforming, and they're outperforming for good reasons, right? Like showing utility cases, real world asset cases, or, you know, basically creating the right infrastructure that, you know, what it needs. The latest CeFi versus DeFi, you know, lending situation has been kind of like the best example to show that why, you know, crypto is here to thrive.
Yeah, so to date, crypto has performed like a high beta risk asset almost across the board. So what causes us to decouple? I think it's incremental flows up and above retail flows, which historically has been sort of what I think has driven most of a lot of the crypto sort of market cap. You need institutional investor adoption, and you need it sort of in size. You need to start to move into, you know, 1%, 2%, 3% place in a portfolio, you know, for those institutional investors. And the only way we do that is by getting better regulation, better security, flushing the bad actors out of the system, all the things that people talk about. But we need incremental flows to actually make that decoupling happen and actually have crypto stand alone as sort of its own asset class.
I mean, given you all kind of each brought up, given like current situations in crypto, we've obviously had a tumultuous couple months with 3 Arrows, with Celsius, with Terra. You know, having that play out with the current macro background has been a pretty interesting dynamic. How much of current market conditions do you think are reflected in current events in the crypto industry versus macro? Tom, did you want to start?
Sure. I think we would probably be down. Historically, the correlations are 0.7, 0.8 for Bitcoin and Ethereum to sort of the NASDAQ and S&P. We'd probably be down, you know, 30, 40%. You know, the S&P's down like 20% or something like that. That's where we would be without all of these blowups. So, and I think an interesting thing to look at is the last few days we've sort of decoupled, right? Yesterday, I think stocks were down 1% or so, and Bitcoin and Ethereum were up, you know, 5, 10%. So can we start to see days like that in the future? It's going to be tough to see.
Yeah, I think there's some, you know, endogenous to crypto events that have exacerbated the fall of crypto. Specifically, the Luna collapse, I think, did some irreparable damage to the retail bid. That'll take some time to come back. And then when you have Celsius and then 3 Arrows, what that did to institutional risk-taking, credit liquidity in markets is quite some damage there. So it's kind of like a 1-2 punch. You have the retail hit, you have the institutional hit, and I definitely think that got reflected in prices a little bit more. Had those things not happened, I would imagine we'd be higher.
Yeah, I was just going to add on credit liquidity, but basically, especially after Celsius and BlockFi, and then, I mean, Luna started it, there's literally, markets are not as liquid as they were. So, yes, very like less opportunity to borrow anywhere. So, I think the prices, I mean, not to predict, but Bitcoin would have been around 30,000. I think so.
Yeah. Seems reasonable.
Yeah.
Agreed.
We have no idea.
Yeah. So let's just run it back and see if we can try that again.
No, because a lot of liquidations happen between 30 to 20. So, yes, it would have stuck around 30 had Luna was the only blow, but no, the blows continue.
Yeah, that's a good point too, because you get these cascading liquidations because people can see where the target values are to sort of push someone's position and actually get it liquidated too. And then once you get down to that sort of new lower level, you kind of sit there and people mentally get it in their minds, Bitcoin now is 20K, let's trade around that, versus Bitcoin's 30K, let's trade around that.
I guess just in terms of what's happening in the macro environment, like how is that impacting capital flow into crypto? And Aisha, I know on the planning call you brought up a really interesting point about LPs and how they're losing money in the equity markets, maybe not allocating as much to crypto or other risk assets. Can you expand on that?
So we are very much institutionally backed, and I'm assuming even Rose's new fund is too. What happened was right around the Ukraine-Russia crisis and right around after Luna was basically just it for some investors where they said, look, we've lost this much money in equities, we need to pull it out of crypto because this is the riskiest asset for us, and we'd rather have no exposure to it. So we were fine, we said it, but then with time we started seeing some more redemptions. Again, people losing in oil, people losing in other commodities, people losing in equities, and then a couple on crypto side, especially Luna exposed funds. So that has changed. Now, whenever I get on an investor call, it's more like, how have we performed from May onwards, not early in the year. That basically just tests us on our stress test. And the check sizes literally went from 50 to 70 million for, just on the LP stage to now like 10 to 15, because the appetite for crypto is kind of like not there anymore. It will change later in the year, especially around the merge. The good thing is that almost every institutional investor you speak to, they know about the ETH merge, they know where BTC stands, and they all have to admit at one point that crypto is here to stay. So that's why I think like early next year, each and every fund of funds or larger banks or whatnot would have like at least 2 to 3% of their book allocated towards crypto.
Yeah, I agree with a lot of what you said. I mean, right now we're actually in the process of fundraising, closing soon. It'll be public who some of our LPs are, and our anchors are very institutional and large. They've, I think, been a little bit more excited about the public market downturn, partially because their businesses are not focused on public equities and have done relatively well. But some LPs we had that were formerly in that 75 mil check range are definitely lower. So in some senses, it's gotten harder. Specifically for us, just like anecdotally, one thing that's changed is when we were thinking about strategy for our fund in March, a lot of it did involve, running delta neutral cash yielding strategies and focusing a little bit more on private markets, just given where markets were. Now, we've basically scrapped a lot of our yielding strats into a completely separate vehicle and are focusing a lot on liquid public markets, just because here risk reward relative to earning yield at these prices versus accumulating delta, we think has changed quite a bit. And I think the LPs have realized that too, and they're much more interested in like double digit or let's say triple digit returns over 3 to 5 years rather than consistent yield, and we've kind of split it into a separate product. So that's kind of how this market has evolved, how we think about allocating just dollars.
Yeah, and we certainly don't talk to the allocators of capital as much, but we do talk to folks, sort of more corporates, and a lot of them are looking to get smart this cycle, which is, I think, different than last cycle. They want education. They understand, as you said, that crypto is going to be around in this next cycle. It's not going away, so we need to learn about it, need to get smarter, figure out a way to invest in it, and figure out smart people like Ro, how to invest with. So it's nice to see that people are taking that step this time rather than sort of writing it off, despite what you see in sort of the headlines on Bloomberg and Wall Street Journal and stuff like that.
And kind of bring it back to the venture standpoint, what kind of trends are you seeing just in terms of capital allocation? I mean, obviously there's been a little bit of a slowdown in funding, but just in terms of broader investment thesis, is there anything that Aisha or Ro, you guys can share?
Infrastructure, ZK, and NFT derivatives, lower valuations. Bear markets are great because this is the only time that builders actually get to build on limited amount of money that they could raise, and you see a lot more growth happening. So we've started seeing a couple of private chains. There was a word out on Aptos today, Sui. So that would be interesting, another set of layer ones probably coming out in the next cycle. Yeah, that's what we've seen so far this month or so.
Yeah, the way we kind of think about strategy in the venture space right now, or even just allocating in crypto, because we kind of view public market or liquid market investments, if they can provide venture returns, they're basically liquid venture investments. So we think of it as kind of like a barbell approach right now, where you have, let's say, a barbell is like early to late stage. We're focused on both ends of it very heavily, which is super late stage stuff that's proven, live, has revenue, whether that's a layer 1, whether it's a token, whether it's an application, infrastructure, equity. That's great. And then also very early stage, things that haven't raised before, pre-product, super early things. I think there's a lot of valuation overhang in the middle, which is like your Series A, B, C, because a lot of these companies raised in 2021 or even earlier, they feel entitled to not raise the down round. There's still a lot of money chasing the follow-on there, and some people can play that game. For us, we don't really want to get involved too much there, so we're really focused on the two far ends of the spectrum.
Well, I was going to ask Tom, I know that you're less engaged with allocators, but any predictions or any thoughts that you have just on investment thesis and current venture trends?
Yeah, I think everyone's all in on the modular thesis. So, it's really where are you building the next sort of, stack that you can accelerate your chain or your protocol? Is it going to be on an Avalanche subnet? Is it going to be on a Cosmos chain? Is it going to be on an L2? I think that's sort of the coming debate a lot of these protocols are having, and sort of who's going to win the day and who's going to provide developers and protocols with the best incentives to go to their protocols. I think is what we're going to be watching throughout this cycle. The thing that I don't think we're going to be seeing is more L1s. I think, Terra Luna kind of threw that out the window. So hopefully not a new influx of L1s that are taking funding from all of these protocols that are actually doing some really good things on Avalanche and other chains.
Yeah, definitely. And then just to kind of bring it back to macro a little bit, obviously inflation is the big headline right now. What kind of signals should we be looking for to kind of gauge whether or not we're in a recession, headed toward a recession? I've talked to a lot of analysts that have kind of said that will be the key pivot point for the Fed to kind of stop focus inflation and move over to recessionary concerns. I'm assuming unemployment will be pretty significant with that. What other factors are you guys watching?
I think there's a difference between sort of a broader economic recession, which is, sort of 2 quarters of GDP down, checkbox for that one, and there's another sort of institution that looks at recessions, afterwards and says, hey, we're in a recession, which I don't really think's super meaningful. But the one that actually is meaningful is sort of an earnings recession. So if companies aren't able to pass along inflation costs to their consumers, if they're getting hit with sort of energy costs and their profit margins are declining and earnings are going down, that's sort of an earnings recession is when the stock market goes down, which if we still believe crypto is correlated, that could be trouble for crypto. So that's what I would look for, earnings season.
Yeah, I mean, I definitely think a big narrative shift to watch out for is going from inflation to recession. I think at a certain point you have to ask whether the Fed cares more about the prices of groceries or how unemployed people are and how jobless things really look. And I think at a certain point they'll have to choose one or the other, and there's a chance that they signal that unemployment is more interesting or more important to them. I also do think you have to look at yields on the dollar versus our sort of neighboring economies or sister economies, particularly the ECB and Japanese government bonds. Arthur actually wrote a good post on this, and I've been kind of agreeing with this view for some time, which is now that the Fed has taken a very tight policy stance and then started to hike a lot. The spreads between us and the euro and the yen have widened so much that those currencies are worth way less. That's kind of hurting those economies quite a bit, and I don't think it's completely out of the equation for the Fed, at the behest of the US Treasury Department, to purchase foreign government assets, and that will effectively unload a good amount of easing into the marketplace while still maintaining the narrative that they're tightening in America, which they will be. They won't be buying American government bonds. They might be selling them at the same time, but just replacing them with other ones. So that's definitely one that could create quite a vicious move to the upside, and very quickly, if that headline were to drop. Got to really be quick on that one and look out for it.
I think we started seeing the slow effect of it, just going back to the job part in crypto, right? Like OpenSea, Coinbase. We'll probably see a bit more layoffs, and that would, probably make this a bigger topic within the community itself. But yes, everything that Ro and Tom have said, I'm agreeing to that.
I hate to get too speculative, but I'd love to kind of hear you all's thoughts on what could turn this market around. Can crypto come back without a broader rebound in equities?
Uncollateral lending on DeFi. That is it. I think each and every builder should go ahead and build it. This market has shown a great need for it. So I think the next cycle, we're probably seeing more stronger applications of DeFi. And I think this is something Rose already said earlier, even on the option side, like derivatives, that's 50% of our fund. We've seen such a huge growth despite of where the market stands in past 2 to 3 months alone. So that's my tip, which would bring the cycle back.
You want to go? I need to think about this a little more.
Yeah, I'm just going to say the merge. I mean, you just need something that brings in institutional adoption or more money into the space. And if you're just having broader global liquidity conditions contract, people need to, take their cash and do something with it and pay their bills and, pay back their debt holders and things like that. And they're not putting it into more speculative assets like equities or crypto. So you need those broader liquidity conditions to sort of ease up before you really can do anything. And the merge might push that flow.
Yeah, I agree with that. I mean, I wish I could say that there was some sort of specific application or something that could single-handedly turn around the market. I don't necessarily think there is. Maybe the merge is the closest thing to that, but I think there's a couple different spectrums of risks that you have to look at. Well, one is the spectrum of where interest rate policy sits, like the Fed. Whether it's tight and credit is tight or credit is loose and rates are low. That's one. The other is more of the geopolitical risk landscape, whether there is an elevated geopolitical risk regime or things around the corner or lower geopolitical risk. And then kind of in that same vein is globalization, how vertically nationalism-oriented supply chains are versus cooperative and sanction-free and tariff-free. So I think right now where you sit, and if you look at all these metrics over time in history, they sometimes they flare up around conflict and war, like World War II, Vietnam War, and right now they're flaring up as well, but they kind of look like the chart of the VIX. They come off after. So you're going to want to see all those things start to shift back, like reduce sanctions, reduce tariffs, lower geopolitical risk, like Taiwan is completely off the table to talk about next year. Hypothetically, if that were true, that would be good. So all those things I think will help bring investor ease back into the market, because that's kind of where I see things really turning. And then, on a more acute sense, yes, there could be the merge, Ethereum becoming a really great deflationary asset, unsecured lending on DeFi. I actually think it's a pretty important thing. But I think those will be secondary to the broader shifting across all those spectrums.
I have a question for you. What about the capital that's literally on sidelines, even within the industry and, even institutional investors from 2021? Do you think that's getting allocated anytime soon, or?
Well, I think a lot of that capital likes clarity, and they're actually happier to buy things 50, 60% higher, whatever, as long as it's a good backdrop tailwind. I think right now the prices are attractive, but the backdrop tailwind, they're still being patient for, from what I've gathered. There are some sort of more gung-ho traders that are you know what, we love this price, max bidding, maybe the Saudis, no, I don't know.
Heard it here first.
But yeah.
No, crypto's kind of a weird asset, right? It's almost more justifiable for sort of more of the buttoned-up crowd when it's at 30,000 than versus when it's at 10,000, because they have the justification, say hey, this thing's going up, hey, it's going to be a real thing. So the more it sits in sort of these ranges, the more justifiable it becomes for an investment.
Oh yeah, one thing I forgot to add was the stable coin wariness. There's a huge percent of people that don't take crypto seriously because of Tether, and now even USDC, people are oh, USDC is insolvent. I mean, all that really needs to be squashed and put to bed to regain some credibility, even though we know, kind of what's good, to regain sort of broader outside of the crypto market credibility. So I think that all that fear has to be behind us. Right now, people still talk about it, and Jeremy Allaire is literally writing line by line what's in this treasury, and it looks fine to me. So as long as people start to realize that, that'll be good.
And then last question, we only have a minute left, but just back on this like correlation train, I mean, can cryptos bounce back if we continue to see a significant sell-off in equities?
It always bounces off around the BTC. What's the 4-year thing? God, like
Merge.
I've had
Not merge.
Happening.
happening. Yes, it always bounces back around that time because around that time the market realizes, oh my God, let's BTC to buy. So that's always a shift. But on the next uprise, it'll probably be Ethereum more, and then other tokens following, other layer ones following. But obviously, it's definitely going to bounce back. I would say probably another year or so.
Wait, was your original question if equities fall, is crypto going to rally?
Yeah, can crypto rally if equities keep falling?
I don't think so. No. Sorry.
Yeah, I agree. Unless we get some awesome regulations that say, I don't know, whatever, provide some clarity that'll bring some sort of incremental flows, I don't think crypto.
Yeah, I mean, I
macro
think
doesn't.
you all brought up stablecoins. I think regulation to the stablecoin market is by far going to be the first significant policy that we see.
I also think it matters why equities would be falling. Like, right now it's more policy driven. If we're in a low interest rate regime and equities are falling because the growth multiples are too high and earnings are low, but like there's still a lot more capital willing to allocate risk and shift, then you could see a decoupling. I think maybe in like 2018 you might have seen that, or around 2018, 2019, where crypto and equities had bottomed, but then crypto behaved completely differently in 2019 than equities at times. But that was a low interest rate regime, and people had, equities were moving differently from crypto. So I think in a high interest rate regime, all eyes are on the same stats, and it's really unlikely if equities fall, crypto is going to rally.
Yeah, I guess the last thing I'll add is, the more cycles we're around, the more different interest rate regimes and sort of monetary regimes and fiscal regimes crypto can go through, the better it's crystallized in the heads of institutional investors what this asset class is and where to put it in a portfolio, and the better it is for crypto. So, we just need more and more time, which is what's going to happen.
Well, certainly a lot to watch. Thank you all so much, and thank you for joining us.
Thank you. Great work.
Great work. Thanks, guys.
Yeah, I'll tell you all about it. Oh, sorry. Photo.
Oh, Tom.
Hello, everybody. Check, check, check. Okay, how's everybody doing out there? We having fun? You enjoying the food? Food and games? Has anybody done the simulator out there? Yeah, is it good? All right. So I'm very excited and happy to announce our next panel. Some really cool alpha here. Scaling Avalanche with Subnets with Patrick O'Grady. Please give him a welcoming round of applause.
How's everyone doing here? Can you hear me all right? We're all good? Great. I've never had a stage before where I could sit down during the presentation, so we'll see if I make use of that at some point today. Well, today I'm going to talk to you about scaling Avalanche with Subnets. It may sound like a broken record at this point, but this is what we really are excited about, especially over the second half of this year, which I'll touch on a bit. I had to use my logo here, this logo here. It's my favorite thing I think we've ever made on a graphic design perspective, so I really had to make sure we got it in. But today, the flow, this is a presentation or a format I've given a few places over the last few months, but the point here really is talk about, very briefly, Avalanche and structure, how subnets fit into it, but then get more into subnet tutorial, how would you create your own subnet, talk about subnets versus L2, what are the trade-offs there, and like what people have been talking about, and then get into some new subnet designs and some of the roadmap that we're pursuing over the next few months, which, if you're at a conference, especially our own, I get to share with you some fun stuff, right? So I'm Patrick. I'm the head of engineering here. Someone made this, the NFT for me. It's my favorite picture of myself, I have to say. So I try to work it in as much as I can. But keep in mind, as I present to you today, I'm presenting the work of a team around me that far better than I am, that I shamelessly take credit for. So just keep that in mind as I talk about what we've been building and what we're doing. Some of them are back there laughing, so they know it. Yeah, let's get into it. So I always just start off, just in case people here are not super familiar with what we're doing and kind of how what we do is made up of. So first off, what is Avalanche? Well, the first thing it is, actually, let me go back there, is a consensus mechanism. The second thing it is a fast and scalable L1. And then the last thing it is a platform for deploying other blockchains or other networks. And that platform for deploying other blockchains and other networks is what really gets a lot of us excited here. I think you've probably seen this slide or some version of it probably 100 times, which is how does Avalanche, the consensus mechanism, fit in? And we talk about all this other stuff we're trying to build on top of Avalanche. You may forget about like the core idea of what all started this. And this is this Avalanche consensus mechanism where through the use of repeated subsampling, you can achieve very interesting properties for consensus in general. So I think the thing there that's most important to like in us is typically the speed to finality is insane because of the way that the network works and the properties of this sub-repeated sampling. So you see some other stuff here around like Nakamoto consensus, and if you're familiar with that with Bitcoin, and classical consensus, which is used by a lot of other proof-of-stake networks. I'm going to pass over that because I think there's some more interesting topics towards the end of the presentation, and just do a quick cover on some of the network subsampling component of Avalanche, which is the big goal, obviously, is you're trying to, in any round of consensus of Avalanche, so any block anywhere on the network or vertex in the DEG, your purpose is to pick a particular color at any one time. And the job of any honest node is just to, or really all the honest nodes, the goal is to align on one color. It doesn't really matter which. That's not really the point of it. But the point is that everyone agrees on the same one. If you don't have that and people, subparts of the network agree on different things, you have safety failure. If you can't come to an agreement, liveness failure. So the whole point is just that everyone agrees on some color. All honest nodes agree on some color. And so I made this diagram to kind of show you what that means in a very brief way, and then I'll kind of expand into a little bit. So imagine you're this one node, you're sampling everyone around you. In this case, you pick k random ones on mainnet, that's 20. In this example, it's 6. And if you query one group of them, you can see in this case there's some oranges, there's some blues. If you get a supermajority, or whatever your parameter is tuned to, what we'll call alpha in this case of the k, you'll consider that successful. And then if you get a number of those in a row, you can then eventually accept that color, and then you're locked in. So very simple procedure in general, but the magical property of all of it is that it resolves very quickly, typically to one side. And so that's why it's called avalanche, is because you avalanche eventually to one side as soon as you get away from an equal split. So I'm not going to get too deep into that. I'm sure you've heard Goon talk about that 20 times better than me. But if you want to see a really cool simulation, recommend scanning that QR code. You can check it out. There's a beautiful illustration that Ted made that shows how the network in a very split state over a period of time rapidly changes to a fully centered network on one color. You can tune all sorts of different parameters, but I'm not going to focus on that too much here today. There's a lot of content online you can look at if you're curious. So what really I wanted to focus on and what we're going to talk about today is subnets and how they fit into this whole picture. So the very brief primer, obviously, is that Avalanche, the network, you may or may not know, is comprised of 3 different chains. And I think the one most people interact with is the C chain, and the second one they probably interact with is the P chain, which handles all the staking and everything that you would do on the network. And then there's also the X chain, which is a directed acyclic graph chain. They all have very unique and different purposes. But the one that that kind of coordinates staking and has to do with subnets is just the P chain. So in the primary network, you can move between anything in here. And the reason why I show this is when that you're participating on a subnet, you have to keep in mind that you're also validating everything here. And before we ship some of the features we have coming, you may wonder, like, well, why do I have to validate this other network to validate, a subnet or do whatever I'm doing? It has to do with trying to have overlapping trust regions that are then beneficial for some cross-subnet communication and cross-subnet basically bridging and stuff, which you'll see as I get further along. But first off, subnets in general. I made this meme once and thought it was the coolest thing I'd made. So again, I love my favorites. So a lot of chatter about what a subnet is, what a subnet isn't. And I think that that's because of how low level it is in some sense. There's a lot of flexibility. So people are trying to craft a higher level narrative of, oh, a subnet is this thing. Oh, it could never do that. Oh, it could never do that. And a subnet, in as specific as possible, is just a very low level interface of what a group of nodes that are validators on Avalanche can do together. With the assumption that they run the same virtual machine and that they work together to achieve some form of consensus, whatever that means. And in some cases, I'll get to at the end, you may not even want to use it for consensus, but most people would in the case of a blockchain. So, well, why do we want this so much? Why are we interested in it? Why don't we just use the C chain to scale to the sun and the moon and whatever? Our theory, or the way that we think about scaling, is even if you pull out all the performance tricks, even if you hyper optimize everything, eventually what you're trying to do is maximize your available block space without undermining the eventual economics of the system that give it its safety. So in the sense of, like, let's just say you take it to the end and you optimize everything, wouldn't it be better to have 10 optimized everythings doing the same thing rather than one big optimized everything? If you have one huge optimized everything, you could apply the same technology to each one of the subnets that are operating in parallel and achieve factors more computation by sharing that everything. So when people are like, oh, you're giving up on trying to optimize the main network or trying to optimize a single virtual machine, no, we're trying to have more of those super optimized virtual machines for all the traffic we see in the world today. And that's what we call the Internet of Blockchains, is that you have many of these things doing their own thing, interacting with each other. Now, in the short term, it's super great for projects. I think you heard earlier today about institutional subnets and what people are trying to do when you can control the set of participants. And then what you'll see towards the second half of the year is more of its use case for permissionless subnets. So, you want to create your own blockchain, and you don't want to be the one in charge. You want people to stake to it. You want people to participate in it, just like you would any other blockchain. But you don't want to build, the 80% of code that Avalanche Go maintains for you in the consensus engine, the storage, the networking. And so what I think we'll see at that point in time is all these great virtual machine developers that know what they want in their application layer stuff, but don't want to rebuild consensus, rebuild storage, rebuild networking, starting to build some really exciting stuff once we unlock a few features that everyone wants. And if you use Avalanche on a regular basis, you would have noticed the effects of people using subnets more so, particularly on the C chain. So the whole point, right, is in areas where there's a need for high composability, like in the C chain with DeFi, if you can have projects that maybe don't need that composability move to their own subnet, you can free up space for people that actually do want it or need it. That benefits everyone, right? So it benefits the people using the C chain. It benefits the subnet, whose users now pay a fraction of what they would have otherwise paid. And so this was a really awesome event that happened earlier this year where Kribata moved to a subnet, and it rapidly decreased the fees that people were paying on the C chain. And then we also had DFK join. Over the next second half of the year, we expect to see a lot of this, except most of it will be from people that aren't yet on Avalanche launching for the first time their networks. So now you're saying, all right, I got kind of this subnet idea. I get kind of why you may be interested in doing it. Well, how would you even launch one? Or like, if I wanted to start playing today, what would I do? Well, I took basically I couldn't show a video here. I've seen so many presentations where like, hold on, I just got this video 1 second, and then it never works, or it goes back and forth. So I instead took a bunch of screenshots, and so pretend I'm doing this in front of a computer. So a few weeks ago, we launched something called the Avalanche CLI. So we have a lot of different dev tools that we use on a regular basis here, and we're trying to unify them into a single place, and that place is going to be the Avalanche CLI. So, excuse me. When you want to start playing around with the subnet, the first step is really just downloading this CLI tool, and I'll show you a QR code at the end if you want, but really just search Avalanche CLI. And once you download that, you'll get prompted to deploy a subnet to do whatever you want. And so in this case, we're going to walk through and deploy the subnet EVM. So pretty simple process. You click deploy, and then you select the virtual machine you want to run on your subnet. Now, this underscores a very interesting point, and the thing that gets into the generality of subnets. It's not just a tool to deploy more EVMs, although that's what people seem to want to do these days. It's a tool to deploy any virtual machine. And as we see other interesting virtual machine frameworks get popular, we will extend it to run all sorts of stuff. So, I threw up a WASM here, I threw up a file here, but just as easily you could have a Move virtual machine, just as easily you could have, Bitcoin virtual machine running on this thing. And I think a lot of other projects will focus really hard on the one virtual machine they want to see and then get really behind it. We're much more agnostic to it and lower level. We want to see any interesting virtual machine running on Avalanche. So once you have that, then you, typical EVM fashion, you pick the chain ID. You specify a few of your fee parameters, what you want to see people use. You specify if you want any sort of airdrop and funds allocation, and then you can activate any number of precompiles. So this is a new feature we added to the Subnet EVM that lets you do a few interesting things right outside the box. And then at the very end, you'll get a little link you can throw in your MetaMask client, or in this case, Core, and start to play around with it. In this case, I went with PatrickNet. So it's a fun little tool to play around with, and we're going to keep pushing stuff through there. But the real question a lot of people have is, all right, you have subnets, but it seems like a lot of people are interested in what you could do instead with like a layer 2 or some other blockchain or something like that. And so I wanted to give a brief kind of overview of how we think about layer 2s, how they fit into what we're doing, and how they're a little different. So before I do that, I'm going to get a quick drink of water. We'll see how this goes. Thank you for the encouragement. Yeah. Gotta stay hydrated. It's hot outside. So. All right. So I'm actually going to sit for this because it's a little easier. I have some detailed notes. So when we're scaling blockchains, it's all about limiting how many people need to compute the same data and how much parallel data can be processed by all the nodes in the network. Now, people may go with different sort of bisection of what you'd want to do, but there can be almost infinite ramifications on the system design as you think about that. And so I wanted to start there, and then I'll kind of go into some of the things you should think about as an engineer if you're using a layer 2. So first of all, one thing that comes up a lot with layer 2s, and one of the big things is around security. So layer 2s take advantage of being on top of I'm going to stand up, it's easier. Basically providing their own security versus using another layer 1 security. So in the case of a lot of popular L2s like Arbitrum or Optimism, right, they're running on top of Ethereum. And so you can take advantage of, maybe a single, in this case, in many cases, a single producer running on Arbitrum or Optimism, and then say, oh yeah, if something bad happens, I'm relying on the security of Ethereum instead. And so then they would say, oh, well, if you're going to launch your own subnet, it's its own network, the security comes only from the participants in the subnet. And yeah, you can totally run it that way. Some people don't want to trust another system, they just want to trust the network itself and the sovereign network that it is. Well, you can do that. So can a subnet provide its own security? Yes. Could you just as equally extend your virtual machine to checkpoint data on the C chain and then use fraud proofs just like you would with another L2? Totally. In that case, a subnet would just be a multi-sequencer network. And once the multi-sequencer got consensus agreement on what was, let's say, the unfinalized preferred block, you could then just post it to the network, just like you could any other L2 posting to Ethereum. Now, if you codified the state transition logic in a way where you could have fraud proofs, you could then trust the security of Ethereum, or you could use that for the C chain and then trust that the hashes or whatever's put there would eventually be fraud provable, and you could then provide some sort of security outside of the subnet itself. So I feel like it's sometimes easier to explain some concepts like this that are a little bit more nuanced through kind of a conversation of like what sort of engineering questions you may ask as you're looking at like L2s versus subnets or anything like that. So in this case, this is a conversation really about L2s and rollups versus subnets, but the optimistic L2 rollup variety. So in many ways, what's important in blockchain is to be fast, right? Like you want to not only have fast finality, but you also want to ship new features and develop very quickly. So, when we're pushing out updates to Avalanche, we're changing thousands of lines of code on a bi-weekly basis. Now, if you're trying to ship all sorts of changes, but then you have this entire architecture built around fraud proofs and being able to relay it on another network, verify it on another network, you have this whole another layer of complexity. And then you also have to make sure that any changes you spin up or whip up, you can actually use in this fraud proof and you didn't break anything. If you're curious about some of the complexity around this, I highly recommend you check out Optimism's Canon implementation, which is like a compilation into a compilation into a compilation that you then run on Ethereum. It's extremely complicated. Now, if it works, fantastic, it's awesome. But knowing what we do on our side of development and knowing that we'd have to keep track of that and maintain that as everything got more complicated, practically speaking, it gets very difficult, and it certainly slows down your process. You're going to have to get all these audits, make sure it's provable. It's a lot of stuff. So with subnets, you don't need to do it to have fraud proofs on a network. You can, but because you don't have all these fraud proofs and everything, if you just want to maintain your own security and just execute, it can be very easy just to spin it up in a weekend. And I don't think I could write a fraud proof in a weekend. The second one is when you're running on an L2 or you're borrowing security from another network, your liveness is subject to that network's liveness. So, if everyone else you're running is alive, but wherever you're trying to checkpoint state is not, well, you're kind of out of luck. When you have a sovereign network, you maintain your own fault isolation. So in a subnet, it runs on top of Avalanche, but only in the state that it manages who is a participant in that subnet. But all the traffic is contained solely to the actual participants in the subnet. So let's say that Avalanche, God forbid, were to have a problem, your subnet would continue on as long as it didn't crash the node or something like that, which typically in most of these consensus failures is because of some uptime thing or whatever. So you could have a much better story around fault isolation. The next one is finality. So when you have a L2, you're subject to some sort of, at least in the optimistic case, some sort of dispute period. So you may post a root, and then you have to wait, let's say, 7 days for someone to be able to post a challenge. Well, if you want to leave that subnet or consider it final, you're now bounded as a 7-day withdrawal period. Now, people may take that risk for you and say, I don't think it's going to fail, and then let you withdraw. But the dispute period on a lot of these is 7 days. If you have a sovereign network and you choose to do that, your finality is less than a second. So you give something up for the shared security. Certainly it's not perfect, but it can be quite a bit of time. And then lastly, an L2, or a lot of the popular ones, are really trying to be extensions of Ethereum. So general compute running with state checkpointed and security provided by Ethereum. If you want to use your own gas token, or you want to have your own configuration to the virtual machine, that's typically not something that they provide. So if you want to provide your own execution environment and your experience, it's not really possible if you just want to have your own network or your own rollup. So this one was just kind of my brief period of a little bit of coverage on what these things are. Subnets, though, they're not a silver bullet either, right? They're their own networks, they're their own blockchains, they're complicated. And there's a lot to think about when you're designing a subnet and launching a subnet. And we're going to get into this with some blog posts we'll draft in the next few weeks, just to kind of remind people they are their own networks. So in a subnet, at least before they're permissionless, there's a subnet control key. So whoever controls the subnet can add validators, cannot. It's really important that they maintain the security of that subnet control key. Otherwise, someone malicious could add a validator that isn't participating or something like that. The other important parts, how many validators? This has been a big question about subnets is, all right, well, the first few subnets only have 5 or 6 validators. And people are like, well, wow, subnets are not safe. Like, they only have a few. Yeah, I mean, we agree 5 or 6 validators is not the goal necessarily, and they can support many more, and we're really excited to see that. So it's important when you're interacting with the subnet that you think about kind of who's participating and who's validating. The other one is kind of the point of this. You're like, why does he have this funny comic? Well, I think it's funny comic up here. Well, subnets, because they don't take advantage or use the main network for anything, besides just the membership tracking, the data itself is not stored anywhere else in the subnet. So if everyone in the subnet just disappears, well, and you wanted to resync that subnet, you really can't do it. So data replication and the peer count on that subnet is also really important. Lastly, I'm going to kind of, I think I'm already over here, so I'm going to move as fast as I can. But the other thing is people getting really excited about changes they can make to a virtual machine. Well, turns out that's really hard. And if you get a little excited or a little ambitious, you may introduce different bugs into your virtual machine. And if you're relying on something like Ethereum where you have basic smart contracts, you may introduce failure patterns that you're not really interested in that could potentially really throw off your project. So I think that's another thing. And then lastly, minor one, subnets can be public or private. If you're using a private subnet, it's much harder to have proper data replication and get visibility into what's going on. So I'm already red. Can I go like a minute over? Great. So what's next? So we're done, right? We can go home. Subnets exist. There's 2 of them. We're good. That's all we wanted to do. We're done. No, not quite. So we have been working really hard on a lot of new stuff related to subnets in particular over the next few months. So you've seen Multiverse, a huge program we launched to encourage subnet development. We have also been building a lot of stuff behind the scenes that we'll launch to bring subnets to a whole nother level. So I'm going to share a few of those with you now and see how it goes. Yeah. So the first one people have talked about is around using subnets that use Avalanche as the currency. So a lot of subnets that exist now create their own currency or their own token and then use that as their own blockchain. Concept we're kind of workshopping and playing around with the use of some VM messaging primitives is the idea of a community subnet. So a community subnet may be built, generally speaking, for a general utility on the Avalanche network that may not be provided by the C chain, the X chain, or the P chain. So let's just say we wanted to have some sort of file storage virtual machine, and people wanted to use Avalanche to pay for that, or take Avalanche out of the C chain or whatever like that to make it happen. Well, the concept we're playing around with is something called a Lazarus subnet, which is once you basically destroy some type of token on the primary network, lock it up, whatever it is, and then these subnets, because they all validate the primary network, can read deposits or read burns from the primary network and then recreate the corresponding amount of token on the subnet. So the reason where the name comes from is it's basically a born-again subnet. So you destroy it and then you're born again on any subnet you go to. Now you may be like, all right, well, am I locking myself in? Yeah, you're locking yourself into using the subnet. But what you can do is if you have a shared contract for this, it's almost like a lock drop or something like that, where any number of community subnets could use the same pool of tokens of people trying to bring Avalanche value. And then you could, at the same time, when bridging or like permissionless subnet bridging comes in, bring it back and allow people to redeem it if they wanted to. This ties into some of the VM messaging primitives that we're working on. And will be interesting to see how people use it. You could build like a C-Chain Pro or like whatever that 10x is the gas limit you're trying to use or something like that, and put some supercomputers behind it or whatever. This one's been interesting. I think the other thing we're looking at is something called a blockless subnet. So a blockless subnet takes advantage of basically the VM messaging and other aspects of the virtual machine interface that don't really need blocks. So the way I think about Avalanche subnets and really the virtual machine interface is more as like a peer-to-peer playground. So I took a small snippet of all the functions that are available to you over gRPC when you create your own virtual machine. So there's the standard stuff you'd hope, get block, parse block, whatever like that. But the box in red is the ability to send arbitrary messages to other nodes of any kind. You don't have to have any blocks or any consensus going on. You could just as easily build like an IPFS, something like it, or you could build a messaging system, or you could build some sort of data caching layer. And thus far, we really haven't seen anyone try to use it for that, but you could just as well. So something that we've talked about, or something that we've thought about, is you could have an opt-in messaging system as validators. So if you join the network as a validator, people would start sending messages to you, or you could have a relay system that just involves sending like ephemeral data back and forth. We were going to do this at the Barcelona summit, or tried to do it, and we ran out of time. But that's one that we've also kept our mind on. But we got a few things here, and you may wonder what's coming next. So what we're really looking at, I think the way I describe our roadmap, or the way that we think about where we're going, is it should be, hopefully, kind of come out of what the community is asking for and what the community is looking for. And the thing that's super clear to us, and we're super excited about it too, obviously, is permissionless subnets. That's what everyone wants. That's what everyone's been asking for. Hey, I love this subnet thing, but I don't want to find my validators. I want to launch my own blockchain, but I feel like I can't because I got to be in control of who can join or whatever. So we've heard you loud and clear. We've been excited about this as long as you have. And so that's really our primary focus right now, and where we're spending a lot of engineering resources. So we hope to have really good news for you soon. We don't basically pre-share dates and launches, but you should keep your eye on that one. The next one, another thing you may want to know, is cross-subnet bridging, right? You have to rely on a lot of third-party bridges if you want to use a subnet. It's a great intermediate solution, and a lot of great teams have stepped up to make it possible to bring things around. And hats off to them, they've done a great job. A lot of people have had a great experience with it. But for people that are starting from scratch, or they may not have a relationship with different people, like who could help them bridge, or come out of nowhere, it'd be great to just give it out of the box. And so that's obviously on our mind too. We think about really what's blocking use cases happening, and it goes permissionless, then it goes right into cross-subnet. And once you have that, you really can take advantage of what we think the power of the Avalanche ecosystem is, rather than just a particular virtual machine. But then once you get there, you're going to want, well, okay, maybe you don't like Golang as much as us. You want to use Rust. You want to use C++. You want to use Python to build your subnet. What comes up next is making more tools to build Avalanche the platform. Avalanche the platform where you can have your virtual machine whatever you want. All your engineers know Java. Great. They can use some sort of Java virtual machine SDK. And we think that where people will go once they can see how powerful and easy it is to spin up their own subnet, will then want to start building much more custom subnets than they currently do now. Right now we see a lot of EVM stuff, but you could just as easily create application-specific thing, new general smart contracting chain. And I think that just takes a lot more flexibility than what we currently provide with our SDKs. And we'll make some cool ones too. So you can stay tuned for that as well. And so this is the last slide I have, which is if you're curious and launching your own subnet, want to make really cool subnet stuff, please apply to the Multiverse program. We have a ton of opportunities for people to get involved. If you're trying to figure out where to launch your next blockchain and you want to know more about what we're doing, we'd love to get involved with you. And there's a bunch of people here that are great at making that happen. But yeah, so thank you. Pleasure being here. I'll see you outside.
Okay, everybody. Thank you very much, Patrick. We're very lucky to have you. Everybody, this is open till 9 o'clock. This concludes our panels. However, there's lots of food and drink outside for you to enjoy. So please do. We have DJ, we have drinks, all kinds of good stuff going on, all right? So get photographs of yourselves with our photographers and enjoy. And I will see you outside and also tomorrow. Bye.